Welcome back to the European market open. A minute to go until the start of cash equity trading. Here are your top headlines from the Bloomberg terminal. Futures are up as the UK and the US market come back from the long weekend. Global stocks are starting the month near record highs already, so gains here everywhere we go makes a new record. Sterling soars to a 3-year high as vaccines spur optimism over the UK's economic recovery. Italy eases restrictions today. Germany getting deeper and deeper into real life as well. And crude climbs ahead of an OPEC Plus meeting today. The alliance is expected to press ahead with a gradual increase in production. A lot of focus on those stocks getting wasted down to nothing by year end. Let's take a look at what's going on in terms of futures here. We get gains across the board. Euro stocks futures have been strong most of the day, as have DAX futures. CAC futures are up 1/3%. Here's your global macro movers screen, and you can see the left-hand column there has equity indexes. As they open up, it populates. So the FTSE straight out of the gate up 1/3%. The IBEX in Madrid, little changed right now, but you can expect to see strong opens for continental indexes. There you see the DAX up 0.6% right at the start of trading. The CAC 40 in Paris up more than 1/3% as well. So European markets opening higher. And of course, US markets are due to reopen later following yesterday's holiday. Investors are looking ahead to Friday's jobs data for reassurance that employment is improving following April's big hiring miss. Joining us now is April LaRousse, Insight Investment Fixed Income Investment Specialist. A lot of words there, April, for a Tuesday. We're very focused on this U.S. jobs number, and I want to know how important you think it is and what you're expecting from the release.
What we're expecting to see is continued good data. We know that the economies are going to be enjoying growth that they haven't seen in decades. So although it will be a bit lumpy, we do overall expect to see an improving trend in employment gains, as essentially companies are being greeted with huge amounts of demand. There's a huge amount of pent-up demand with all the savings. They're busily finding their way back into the economy, and that means, of course, they're going to have to actually hire some people to fulfill the consumer demand. So good numbers are expected from us.
It's been tough. I know from, anecdotally speaking to hotel operators, restaurant owners, et cetera, it's been hard for them to get people back in the door because unemployment benefits are relatively generous. What do you expect to see on the wages front? Are they going to have to raise wages further to get people back?
We have seen that already in some parts of the service sector, that they have been trying to tempt back people a little earlier than perhaps they'd be comfortable coming back. And so, yes, in some sectors, we're expecting to see a little bit of wage growth. But overall, we don't think that that's going to be something that's going to be enjoyed generally across the economy. You have seen various states actually not extending those more generous unemployment benefits. Schools are definitely gearing up to be fully functional as well, which has also been an issue in the U.S. of getting people back. And of course, the virus rollout has been a real success in the U.S., and that should encourage people also to be comfortable going back to work. So, we look at what we're expecting for wage growth, and we're not expecting to see a sort of boom higher in wages across the economy.
Yeah, absolutely. No, the vaccine rollout has been incredible to watch in the U.S. I know that, in Germany, they make you wait a long time between shots. And in the U.K., it seems like they make you wait years in between shots to try and get everyone the first vaccine. But the U.S., you could just stop by, it feels like your local Kmart and pick one up. How is the Fed going to react to, if we get a really positive print, April, and we start to get the kind of inflation numbers that the market hasn't priced in? What are you expecting from Jay Powell and co.?
Yeah, the Fed's really on a dilemma. They're kind of trying to ride two horses at the same time. They want the economy to recover and run hot because, of course, the economy contracted by 3.5% last year. They want unemployment down. That's part of their remit. It's still around 6. Pre-COVID, it was 3.5, right? So they know they've got some work to do. But of course, the inflation data is showing what you would expect. Nobody's really been able to shop. In the U.S., that's a real problem. People are getting out there with their massive amounts of pent-up demand. Inflation is going to be high. We're expecting that inflation will peak, around that 5% level, potentially a touch higher by the time you get to sort of the all-important 4th of July. Then you'll see inflation start to come down, but it really won't come down to closer to 2%, really until 2022, end of 2022. So, it's going to be a while where we're going to see inflation well above 2%. Of course, the Fed has told us that's not a problem. They're doing flexible inflation targeting. And they haven't told us what the look-back period is for calculating the average level of inflation, which gives them a heck of a lot of leeway. So really what we're expecting to see is the Fed will continue to talk very calmly, very dovishly, so the market doesn't get spooked. And just say these are transitory. These things aren't going to last. It's natural. The supply chain wasn't ready for the sheer demand.
All right, we're going to continue talking about this, April. Leeway, of course, is what they like, right? They want to keep optionality open, and the demand. I see the demand there, but I didn't catch the same savings train as everybody else. I don't think. I felt like Amazon took up a pretty decent amount of my disposable income. April LaRousse, Insight Investment Fixed Income Investment Specialist, stays with us. We're going to talk reopening here in Europe coming up. Italy reintroduces indoor dining as low-risk areas, as its vaccine drive kicks up a notch. We've got all the details next. This is Bloomberg.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Welcome back to Bloomberg Markets. This is the European Open. We are 10 minutes into the trading day right now. We're looking at green arrows here across indexes. The DAX in Frankfurt up 0.75%. The FTSE itself is up almost 0.5%. For a moment, an hour ago, futures were lower. So you can see we're moving higher. Let's take a look at what stocks are on the move this morning with Bloomberg's Danny Berger. Danny?
Matt, at the start of the open, at the very first minute, Royal Mail was the biggest gainer. It's paired some of those gains, but this is around some brokerage action. Citi raising Royal Mail to a street high, about double the price where it is now, 1,000 pence. Basically, they say, look, we have elections in the UK, you have return to economic growth. Apparently, all of that means more letters. I get the election part, but I guess economy is growing, people are sending out sort of mailing advertising, and they see more momentum in their parcel services. So all of that means some gains for Royal Mail. On the other side, though, the biggest loser on the stock 600 today is the video game maker out of Poland, CD Projekt. Matt, this stock is so volatile. I feel like every day it's either one of the biggest gainers or one of the biggest losers. Not great news for them today. They had their earnings, and sales of their Cyberpunk game were pretty disappointing. At the end of last year, they sold around 14 million units. In the first quarter, it was closer to 1 million units. Of course, people aren't buying as much as it's not new at this point anymore, but at the same time, it's also no longer in the Sony PlayStation Store. They gave no visibility as to when it might come back. The game had a lot of glitches. That's why it's not in there at the moment, so those shares selling off pretty significantly. Also, macro moves contributing a lot to what we're seeing specifically among UK stocks today. You have a lot of the oil majors moving higher, a lot of the materials sector moving higher, with iron ore doing better. Antofagasta, one of the biggest gainers so far today. If you look at the top moving stocks, nearly every single one of them is in the energy complex or a material company. With that being said, we are seeing Brent crude move above $70 a barrel ahead of the OPEC Plus decision. But if we have oil participating in this commodity rally, maybe that will set the stage for a super cycle in commodities, because you need participation from oil. Whether it happens or not, we are seeing that inflationary story continue to play out. Again today, you have gold finally getting attractive to people as a hedge, moving above $1,900. U.S. 10-year yields, cash market finally open again, up some 2 basis points, Matt.
Your gold has been on a tear for sure. In terms of CD Projekt, do you play Cyberpunk 2077?
I don't. I am an Xbox person, and I don't have it on that. I actually don't have my Xbox in London. I left it when I moved. So I'm more of like a Halo player. That's more my vibe.
Amen. Absolutely agree with you. Halo lover, also Call of Duty player. My gamer tag is Shower Fan if you want to sign up and have me pwn you. By the way, I've got 2 Xboxes, Danny, so I'll send you one to the UK, and then we can get a game on. All right, now, one of Europe's largest economies is rebounding. From today, restaurants in Italy's low-risk zones can serve customers indoors for the first time since February. Other businesses in these areas, including gyms and shopping malls, will also open up, so it's getting back to business for Mario Draghi and the country. For more, we're joined by our Brussels correspondent, Maria Tadeo. What are the key changes we're looking at here, Maria?
Yes, Matt, and it's this gradual reopening for the Italian economy. We're going to see indoors dining now being approved and being okay. We're going to see gyms and shopping centers also reopening and taken in public, and ultimately tourists coming outside of the European Union, holidaying in the country. Now, that's a big sector for the Italian economy. A lot of this is being driven by the pace of vaccination and inoculation. If you look at the start of the year, Italy was vaccinating 170,000 people a day. Now it's vaccinating more than 600,000 people a day. All of this is happening under Mario Draghi. Remember, he said his #1 priority was to deal with the health crisis and coronavirus. Now, the Bank of Italy says they already see momentum going into the economy that should really manifest in the second half of the year if that pace of inoculation continues to go up.
All right, so looks like they're coming back out. And by the way, Germany is considering some real reopening moves, or at least the Berlin Senate. My producer, Agatha Cantrill, just came in here and told me is debating today the possibility of indoor dining and gyms reopening here in the Hauptstadt as well.
You know, that's very good. And Matt, you know, what it shows is that the vaccination campaign is really picking up in Europe. It really has done in the past few weeks. And, you know, the Commission will still say we are heading for herd immunity in July. So this is now a very different picture, a very difficult rollout at the beginning, but now moving full steam ahead.
Cool. Maria Tadeo, thanks very much for joining us out of Brussels on the reopening. April LaRousse, Insight Investment Fixed Income Investment Specialist, is still with us. So, April, what do you make of the reopening? We saw inflation in Germany tick higher.
Yeah, well, we're expecting to see a gradual reopening across Europe, and that's likely to lead to quite, decent growth recovery overall. Inflation risk in Europe is incredibly low. The demographic trends don't support it. All of the underlying data are suggesting that you might see some short-lived, sort of lumpy prices where you get numbers creeping up a touch, but it is really, really unlikely to lead to any kind of market concern about inflation becoming an endemic problem. And really an unhinging of inflation expectations across Europe is really highly unlikely. But, you're going to get the same thing. All that great news about reopenings, there will be some pent-up demand there. Supply chains may, of course, have been disrupted by COVID. So there'll be some numbers that you might think, oh, that looks a little higher than expected. But overall, inflation risk in Europe, very, very low in our view.
And, the interesting thing is, April, when I talk to CEOs of all the car manufacturers here, when I talked to the CEO, Roland Busch of Siemens, a couple of weeks ago, they are passing on higher input costs to consumers, and they're adding padding to build their margins. So, in terms of at least these big ticket items, durable goods and, CapEx purchases, prices are going to rise.
They may be able to get away with it, I think, initially, especially when there is this pent-up demand. But, in order to be able to sustain that, I think you need a very different dynamic. So, definitely in some areas, for example, we've noticed in real estate, property prices are very firm. In the U.S., you saw strong demand for used cars, but even for new cars. But in Europe, it's not quite been the same picture. Yeah, you've seen decent real estate, but there hasn't been the same sort of huge amount of pent-up demand for some of these more expensive durables. I guess the issue for us, though, is does it really change people's long-term inflation expectations? And
what do you think happens on this?
More than that.
What do you think happens on the spending and borrowing side, April, especially if we get a green government, a green player, let's say, in the coalition government here in Germany from September?
Yeah, you could see a little bit more spending than you've certainly seen before, and for the most part, that's pretty welcome. I mean, generally across the developed world, there has been this kind of underinvestment in some of the infrastructure projects, and certainly the green rollout is something which is popular across Europe generally. So yeah, we wouldn't be surprised to see a bit more spending coming out of Germany should the nature of the government change. But I guess, the degree to which that changes where Bund yields are, any other of the spreads that you might watch across Europe, is probably going to be pretty small. I mean, the key really for all of these economies is, what are their debt service levels looking like rather than the overall level of indebtedness? And the debt service levels are still incredibly low, right? So if you look at what it costs the German government on interest costs as a proportion of GDP, that's 0.7%. That's an incredibly low number. So, Bond yields practically zero, negative in some cases. You know, you can spend a bit more and it's not going to cause a problem for the economy.
So un-German, though, but I think, yeah, it's definitely become the new way to operate. April, thanks so much for joining us. April LaRousse, Insight Investment Fixed Income Investment Specialist. April's going to continue the conversation with us on Bloomberg Radio at 9 a.m. UK time, so if you have London DAB digital radio, do tune in. Let's get now the Bloomberg Business Flash. For that, we go to Laura Wright. Laura?
Thanks, Matt. Almost 3 years after a deadly bridge collapse in Genoa, the battle to control Italy's largest highway operator is nearing an end. Some 87% of investors in Atlantia have backed the sale of the company's Autostrade roads unit to an investor led by Italy's state-backed lender. It's an 11th-hour victory for the Benetton family, who control the infrastructure giant. Reuters reports the Porsche and Piëch families are preparing to take a direct stake in Porsche if the luxury car maker is separately listed. A Porsche IPO is not high on the agenda, although owner Volkswagen is considering scenarios for a flotation. Porsche and Volkswagen declined to comment on the Reuters story. Kraft Heinz is investing £140 million to upgrade its factory in the northwest of England, potentially creating as many as 50 full-time jobs. The investment is set to be the company's largest in more than 20 years in an existing facility outside the US. The plans will see ketchup, mayo, and salad dressing production return to the UK. That's the Bloomberg Business Flash. Matt.
Laura, thanks very much. Laura Wright there in London with your Business Flash. Coming up, China's finance ministry considers transferring its shares in Huarong to a new holding company. That's as it examines ways to minimize the risks posed by the asset management firm. More on that next. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome back to Bloomberg Markets. This is the European Open. We are 23 minutes into the trading day. You can see you've got green arrows across the board in terms of equity indexes that are trading. The UK for the first day this week, as it was closed yesterday for the bank holiday, up 0.4%. The DAX in Frankfurt up 0.75%. U.S. futures are also on the rise. Now, China's finance ministry is considering a proposal to transfer its shares in China Huarong and other bad debt managers to a new holding company as part of discussions on how to deal with the financial risks posed by the firm. For more on that Bloomberg scoop, let's bring in China credit reporter Rebecca Chung-Wilkins. Rebecca, tell us first of all about the details. This has been such a hot story for the last few months. What does this mean now, especially for Huarong debt holders?
Sure. So it's really the latest step in the very long story of kind of turmoil at Huarong. Essentially, this proposal would see the transfer of shares in Huarong and the 3 other major asset managers into a separate holding company. And officials essentially see this as a way of delineating the kind of responsibility of the government as a role of a regulator versus the role of a shareholder. So it's another step in trying to curb financial risk in this sector. The key question, of course, as you say, is what does this mean for investors? And the fundamental question is, what does this proposal mean when it comes to the promise of the state, the state support for Huarong if it continues to run into trouble? And there's still a lot of uncertainty over that. I will say that we are seeing quite a sharp sell-off again continue in the other asset management dollar bonds this morning.
Why is this plan being proposed now? I mean, what's going on in China as Xi tries to sort of fix the moral hazard problem? Why deal with this in this way and at this time?
Yeah, I think this question of timing is really crucial when it comes to looking at Huarong. So, in fact, this proposal was first actually voiced 3 years ago, and we're just seeing it being kind of revisited again now because of all of the scrutiny that the asset managers are holding. And fundamentally, this comes down to what kind of credit risk at Huarong and what a potential default or restructuring could mean for Huarong. That would change, the fundamental nature of bond valuations across the market, but particularly for the other asset managers. So it has become a priority to really try and curb financial risk there and to really try and shape these up and get them back to kind of their original mandate of dealing with bad debt.
All right, Rebecca, thanks so much for joining us on, this is a developing story. It's been so fascinating for so long, and it continues to be. So China credit reporter Rebecca Chung-Williams in Hong Kong on Huarong. Coming up, oil tops $70 a barrel after OPEC Plus forecasts global supply will tighten in the second half of 2021. More on that, and of course, the OPEC and Friends meeting later on today will focus in on the commodities in general. The boom continues as we begin the month of June. This is Bloomberg.
traffic.
Okay.
During the pandemic, no traffic at all.
Okay. Where do you see the oil market in about 20 years or so?
Non-existent.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to Bloomberg Markets. This is the European Open. We are a half hour into the session and looking at a gain on the DAX of 0.8%. The FTSE is up about 0.5%. So stocks are rising this morning. The first day for the UK, first day of trading for the UK this week, and it will be the first day of trading for the US this week as well. U.S. futures also on the rise. Let's take a look at which sectors are on the move in the live trade here. For that, we pull up the group ranked returns screen. So if you look at, I guess we're going to look at the SXXP, the Stock 600 index, in terms of groups, the basic resources. So the miners and metals are rising the most. Auto parts and automakers are gaining. The second most. Energy is also up. So commodities really behind the drive higher, as well as cyclicals like Daimler, BMW, and Volkswagen, plus travel and leisure, construction, and the banks. So, most groups are up, but it's really that reopening play that seems to be driving gains. Let's get the Bloomberg First Word News. For that, we go back to London and Laura Wright. Laura?
Thanks, Matt. Angela Merkel says she's ready to allow Germany's controversial lockdown law to lapse. Mandatory restrictions, including curfews for hard-hit areas, were introduced back in April, effectively suspending states' rights. The country has been gradually easing restrictions as infections fall and vaccinations accelerate. Japan is preparing to allow some domestic fans to attend events at next month's Olympics. That's according to TV Asahi. Spectators would be required to provide a negative virus test or a vaccination certificate. Fans from overseas are not allowed to see events in person. China has raised the reserve ratio for the bank's foreign exchange holdings in its most visible measure yet to curb the yuan's gain. Starting June 15th, financial institutions will need to hold 7% of their foreign currencies in reserve. That's an increase of 2 percentage points and marks the first time the PBOC has made such an intervention in more than a decade. The yuan's recent rally has taken it to a 3-year high. The International Atomic Energy Agency says Iran has produced a record volume of highly enriched uranium. The confidential assessment of the country's atomic program comes as envoys hunkered down for an 8th week of negotiations in Vienna. The report says Iran made 2.4 kilograms in the 6 weeks since saboteurs struck the country's primary enrichment facility in Natanz. Global news, 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Matt.
Laura, thank you very much. Laura right there in London with your First Word News. Now, Brent crude has topped $70 a barrel after OPEC Plus forecasts a tightening global market. The alliance believes that the glut created during the pandemic has nearly gone, and oil stockpiles will drop rapidly in the second half of the year. That comes ahead of a virtual meeting of the producer cartel and friends later on today. Joining me now is Bloomberg's Anthony DiPaola. So, Anthony, what are we expecting OPEC to decide on today? Given the outlook, are they going to say, okay, now we'll open the taps into the second half?
Hi, Matt. Today, they're going to be mainly discussing kind of an easing that they had already laid out in terms of how they would go about it. They're slowly bringing on about 2 million barrels a day of crude oil, and they're supposed to complete that through July. So they're expected to just kind of go ahead and decide to continue with that easing in July. They're going to talk about the second half, from what we understand, but not really make any decisions yet today. That report from a committee meeting yesterday was pretty positive, as we can see from oil prices, that the market is going to be tightening simply because they're holding production off the market, and demand is increasing as economies recover. There's a couple question marks out there. Iran could come back if there is a deal reached between Iran and several global powers, and just the pace of recovery of the economies. I mean, we've seen the issues with India as the virus has spread there. So other outbreaks in large economies could be a setback. So OPEC is going to leave some wiggle room for themselves in the second half to react to demand and to hold that supply until they need it, Matt.
Yeah, so the possibility of a resurgence in the virus is one of the headwinds for prices. On the other hand, you mentioned the Iranian talks also in Vienna, I think in an 8th week now, but looking like they're ready to conclude. How much oil does Iran add to the equation?
Iran is already exporting some oil now. Estimates are in the range of, say, 600,000 to 800,000 barrels a day, and people are expecting some additional million barrels a day or so to be able to come back on the market this year. That's still a little bit shy of what they were exporting before the Trump administration increased sanctions on the energy sector. But as we've seen from past sanctions rounds, when restrictions have eased, Iran's been able to bring production back pretty quickly. So if we do get a deal before the Iranian elections, which are coming up later this month, then that could lead some production to come back in the third, fourth quarter. If the deal is later, then that pushes that back. But most of the market expectations are that we will see some oil back to the market this year, and that's one of the things that OPEC is watching, and that's why they're giving themselves wiggle room, Matt.
All right, very interesting story. We'll be watching closely. Anthony, thanks so much for joining us. Anthony DePaola covering the oil sector for us. Coming up, the OECD's Angel Gurria warns that many parts of the world are being left behind by the pandemic recovery. He says now is not the time to worry about inflation. This really also feeds into our big take story today. Highly recommend you read that. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Welcome back to the European Open. We are 40 minutes into the session, and we're seeing continued gains, actually appreciations here across equity indexes, with the DAX now up 1% in Frankfurt. Let's talk about tennis, though. The world's #2 women's player, Naomi Osaka, has abruptly quit the French Open after a disagreement with tournament officials about participating in mandatory press conferences. For more, we're joined by Bloomberg's Caroline Conan in Paris. So, Caroline, why exactly did she drop out of the tournament?
So, Matt, last week, before the tournament actually started, she had already warned on Twitter that she wouldn't participate in those press conferences because people, quote, have no regard for athletes' mental health. So, of course, money and mental health in sports, very sensitive subjects. You can imagine the reaction on Twitter, given her star power. She's the #2 female tennis player, and she has won 4 Grand Slams, although she's never won Roland Garros. So on one side, you had fans supporting her. On the other side, those criticizing her for being too sensitive or not fulfilling her professional obligations. The situation escalated over the weekend when Roland Garros, the French Open, actually said that she could face a disqualification from this French Open and other majors in the future. So she decided to quit last night, quote, saying, "The best thing for the tournament, the other players, and my well-being, so that everyone can get back to focusing on the tennis." She also said she'll take some time away from the courts. Roland Garros, the French Open, had a much briefer reaction last night, saying it is unfortunate, but she's welcome next year. The news came as a bomb, of course, especially in the sporting world in these COVID times when the whole sporting events have suffered a long absence from the public for the past year.
Is there a market impact this morning? How are we seeing this play out?
She is 23 years old, but she is currently the highest earning female athlete according to Forbes, with more than $37 million in the past 12 months. So you can imagine the sponsors and the endorsements she's got, about 15 endorsement partners. So her withdrawal is having an impact on the shares of its sponsors this morning, especially a tennis racket maker, Yonex, the instant noodle brand Nissin Foods, but also some other brands such as the cosmetics maker Shiseido and the watchmaker Citizen Watch, for which she is an ambassador. We'll also have to watch the reaction today on the shares of the French Open sponsors, including the bank BNP Paribas, the historical sponsor, and also Osaka's clothing sponsor Nike. Nike has even launched last winter an Osaka streetwear line with her own logo. So a very big contract she's got with Nike. In the longer term, of course, this sends a very strong message to the organizers of the tennis tournament and all other sporting events in the future, of whether they'll have to find a compromise with those tennis players who don't want to participate in the media frenzy against these events. And of course, we'll have to watch also if she participates in the Tokyo Olympics, for which she is expected to be one of the big faces.
All right, Caroline, thanks very much for joining us. Bloomberg's Caroline Conan in Paris. talking us through the tennis situation. Let's get the Bloomberg Business Flash now. For that, we go to Laura Wright. Back to Laura Wright in London. Laura?
Thanks, Matt. China's finance ministry is said to be considering transferring its shares in bad debt manager Huarong to a new holding company. Some officials view the possible move as a step towards separating the government's roles as a regulator and shareholder. Authorities are also discussing whether to bring in more external investors. Philippines-based Mond Nissin says it will use some of its billion-dollar IPO proceeds to expand its corn food plant-based meat business in the U.S. Its shares debuted today in Manila after the biggest ever offering for a Southeast Asian food company, trading close to their initial price in the morning session. The company's CEO says the alternative meat business is poised to explode despite the pandemic.
We have to expand a lot during this period because the portfolio that we have, which is alternative protein, is poised to grow exponentially. So we don't want to miss the opportunity. We want to have the fund ready. We are going to use it immediately for our capacity expansion.
That's the Bloomberg Business Flash. Matt.
All right, Laura, thanks very much. Laura Wright there in London with your Business Flash. Now, a strengthening world recovery from the pandemic risks leaving many regions behind, fueling inequalities across and within borders. That's the view of the Organization for Economic Cooperation and Development. The OEC's outgoing chief, Angel Gurria, says that vaccination rollouts will define the global recovery.
We feel it's pretty solid, it's pretty robust, but it depends crucially on whether we can keep up the rhythm of vaccination. It's vaccination, vaccination, vaccination. That is going to define how robust the recovery is. And the other question is it going to be vaccination only for the wealthiest countries, or are we going to generalize it? We need a very important effort to be able to get vaccines into the arms of people in developing and emerging economies. Without that, we won't be able to say that we've overcome the crisis.
Yeah, the wealthiest countries are going to be looking at 60, 70% coverage in the next weeks and months. I mean, they're well on the way to done. How long is it going to take developing nations to get to that kind of vaccination coverage?
The answer is how smart and how generous the developed countries will be. If they are smart and generous, and that means that it's the same. Being smart means being generous means smart. Then we should fund mechanisms like COVAX. We should get only a fraction of the trillions that have been thrown at the virus. Just a fraction of that will do the trick. You can vaccinate everybody in the developing world with between 50 and 100 billion, whereas upwards of 16 trillion have been dedicated to fighting the virus. So only a fraction will do it.
What kind of, we know that there's going to be an uneven recovery because of this discrepancy in the vaccination paces. And in fact, some developing nations are going to take years to catch up to the levels the EU and the US are looking at right now. What are the risks of such an uneven recovery?
The risk is that, now it's become almost a cliche to say that nobody's safe until everybody's safe. And also because the enemy is mutating. The enemy has variants. It's changing its shape, its DNA, and therefore we should not allow it to do just that. We should try to beat it as early as possible. And by the way, it's a false dilemma to say that we should balance the economy, you know, the lives and the livelihoods, and the question of health and the question of the economy. Clearly, the very obvious choice is get the virus, kill the virus, beat the virus first, and then because the virus is having immediate consequences on the economic side, on the social side,
right?
And those will stop the moment we stop the virus.
That was the OECD Secretary General, outgoing Secretary General Angel Gurria, warning that many parts of the world are being left behind by the recovery from the pandemic. It's something that you hear a lot, but we just can't say it enough. Coming up, WTI crude hits an intraday high not seen since October 2018. We'll discuss oil prices ahead of a virtual OPEC Plus meeting today. More on that next. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Open, almost an hour into the session, and we're seeing gains that continue to appreciate. So the DAX now up more than 1%. The FTSE 100, 2 hours ago when we were prepping for this program, the futures were down in the UK and in the US. It looked like we were going to have a negative open across those two markets that were closed for the holiday yesterday. Now we have FTSE 100 futures up almost 0.8%, and U.S. futures continue to rise as well. So it looks like it could be a risk-on day. Joining us is Ven Rom, Bloomberg's MLive currency and rate strategist. Excuse my excitement, Ven, because, we're seeing gains here in equity markets to kick off June, and we have already, in most indexes, we're already at record highs. So Whatever happened to sell in May and go away? Let's get, though, to you right now. In terms of the commodities, we see also continued run-ups. Gold gaining today, oil up again today. Ven, what do you think of this market?
Well, these markets are frothy everywhere, Matt. I mean, whether you look at commodity prices or, as you mentioned, equity prices, we are exuberant all over the place. The only place where there is a bit of caution is in the rates market, where we are seeing yields tick up slightly. So that may kind of put the brakes on equity valuations. And of course, we've got the big payrolls data coming up this Friday. So I do think that we are setting up for a good week this week. Matt?
What are you looking for in terms of payrolls? And, it's such an interesting report because not only do you get the non-farm payroll additions, but you also get the wage information, and that all helps the Fed make a decision on when to talk about tapering.
Absolutely. So in terms of the payrolls expansion, we want a significantly bigger number. And in terms of inflation as well, we had the core PCE numbers last week, and those were not really convincing enough. I mean, basically the core PCE numbers are telling us that, look, I mean, the market's estimates of forward inflation as priced by the five-year swaps are in the ballpark, and they are not wrong, and that's what the core PCE is saying. What we need for rates to tick higher is vastly outsized prints, meaning an inflation number, say, that's out of the park, and that's what will bring that's what will put some pace into the inflation expectations number, and then it will bring back into the front burner what the Fed should be doing in terms of taper.
We're just getting German unemployment figures out. The drop of 15,000 puts the total number at 2.74 million. It's about 6% here. Keeping this in mind, Ven, and we've only got here 30 seconds, but what do you think about the euro and the pound's appreciation against the greenback?
I think the pound has legs to build on its gains, particularly if Treasury rates do not go any higher. And that's because the reason I say that is, if front-end yields in the UK rise, and I think there's a lot of potential for them to rise, given what the BOE said about rate expectations, I think that sterling will be bid in the coming months.
Ben, always great to talk to you. Pleasure. Thank you so much for joining us. Ven Ram there is Bloomberg's MLive currency and rate strategist. You can see his work and the work of his colleagues by typing MLIV Go on your terminal. That's it for the European market open. Surveillance early edition is up next. Francine Lacroix is back, I believe, I hope. And we're looking at a gaining market. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is not the time to worry about inflation. The enemy's still there.
I definitely support more investigation into the origins of the pandemic. I am concerned, though, that, that this turns too adversarial.
We have an issue with Airbus that we need to settle, or Qatar Airways will not take any deliveries from them.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, the Early Edition. I'm Francine Lacqua in London. Here's what's coming up on today's program. Global stocks start a new month near record highs, but could concern over inflation force central banks to take their foot off the gas? We speak with Jim O'Neill on the shape of the recovery. Italy eases restrictions in the latest big test for Mario Draghi. This hour, the world-famous restaurateur Massimo Bottura joins us to talk resilience in hospitality. And will China's moves to rein in the surging yuan shift the dial for investors? We get the latest on the PBOC policy. Well, good morning. Lots ahead in today's program, including an imminent conversation with the Chatham House chairman, Jim O'Neill. I know he wants to talk maybe about football, but more than football, we'll talk about BRICS and, of course, the recovery and what kind of markets we'll see. First, though, it's a new month, so let's get straight to the markets with our Danny Berger. Danny, happy June.
Happy June, Francine. And finally, we're away from the month where apparently rhymes dictate how we trade, the sell in May, and go away. But look, it didn't play out. Seasonality is, of course, important just because if a trend has historically held, then perhaps it will continue to hold in the future. And look, on a headline level, ending the month with a 0.5% gain on the S&P 500. But underneath the surface over the past month, there has been more volatility. And this is, of course, important in terms of where we go from here. And that volatility really manifested itself in selling out of tech. So maybe it was sell tech in May, with the NASDAQ 100 falling more than 1%. And within that, we get this very sort of rotational, reflationary type vibes. You want to sell the higher value stocks. This is something we'd heard earlier in the year. The narrative kind of muted, but really did come back last month, even though it was kind of hard to tell day to day because it was very volatile. And you had small caps, for example, doing well. Of course, the other way to look at this is in factors as well. So let me take you into my terminal because, Francine, I'm never too far from the FTW function. That's factors to watch on your terminal. And when you look at what did the best over the last month, you have things like size, for example. So these are smaller caps that we're talking about. Value, so value does really well and starts to come back. And on the bottom, you have things like momentum, growth as well, not as high up on the list. So you get this clear rotation. Now, in terms of where we go from here, the thought is that this can continue, at least when it comes to UBS Global Wealth Management, Mark Haefele, who basically says that the setup is there for this market to keep going. So let me show you what he said. He makes 3 points really in terms of why this will continue. One is just the economic growth we've seen. Of course, what happens on Friday with the jobs report could maybe change this picture, but so far the economic recovery has been clear. We've also had earnings growth in the US and globally where companies really surprised to the upside. And finally, if the Fed is going to stay supportive, they're going to let the economy run hot. that means that this sort of reflationary trade can continue. So Francine, at least the consensus at the moment is what we saw in May may continue to repeat itself in June.
There you go. Okay, Danny, thank you so much. Danny Berger there with some wise words that actually get put to test. Now, investors didn't sell in May and go away after all. The doubt comes from the idea that in the summer months, market activity drops as traders go off to the beach. Clearly, that isn't easily done in a post-pandemic world. Now, the key question for investors now seems to be whether rising price pressures will prompt central banks to withdraw support sooner than expected, this despite the pandemic still raging in some parts of the world. Now, yesterday, we also heard from the OECD raising its global growth forecast for 2021, warning that the recovery is uneven. Now, in a recent article for Project Syndicate, my guest host, Jim O'Neill, said, although some recent high-frequency indicators have cast a shadow on what previously appeared to be robust, rapid recovery from the pandemic-induced recession, there's still ample cause for optimism. But much will depend on how well policymakers in the major economies manage the foreseeable risks. Well, let's get straight to Jim O'Neill, Chatham House Chair and former Chairman of Goldman Sachs Asset Management. Jim, as always, thank you so much for coming on, and what a brilliant article that you wrote for Project Syndicate. What would be the biggest policy mistake right now?
Oh, gosh, that is a really tough question to start off with, Francine. Thank you.
I know. No icebreaker.
I think the toughest thing, the biggest mistake would be for them to rush to do anything. I think a lot of what we've seen has been, even by the standards of some of these high-frequency indicators, surprisingly predictable. I have to say, especially after seeing these Korean export numbers a couple of hours ago, I have never seen anything quite like it from the indicators I've followed for 30-odd years. Astonishing cyclical recovery going on. But when you sort of stand back from it, whilst it might surprise people that aren't more used to, this kind of intensity of high-frequency changes, I think the policymakers should be careful about rushing to what many in the markets are trying to persuade them that it is now a done deal that underlying inflation is back. Obviously, the very latest readings we had in the US suggest it could be, but 1 month is 1 month. So, but that said, I think the heightened attention on as many anecdotal indicators about wage behavior and with it pricing behavior by companies to make sure they've got a handle on the inflation expectations process is crucial, absolutely crucial. I remain unsure myself whether we are seeing a real pickup in inflation or not, and it could be. But what is clear, another 3 months, say, of this intensity of global recovery, and central banks are going to have to start thinking about reversing their easing. No two ways about it, if it stays like this.
If it stays like this, but what is the danger that we're underestimating actually how effective vaccines work longer term, or variants, or do you think we're pretty much, it's hard actually being in the markets because we're not virologists, and so it's difficult to see how this kind of, where it ends up.
Well, the answer to that is nobody knows, Francine. Even though we're 18 months into this pandemic, each twist and turn, nobody knows quite what happens. They still don't know, for example, here in the UK, what is the virulent strength of this so-called India, or now rechristened as of this morning, the Alpha vaccine, Alpha variant. It looks to me, and as you know, I'm quite involved in some of this health stuff, so I'm following a lot of the numbers really closely. It looks to me as though after initial scare about 10 days ago, the rate of increase in overall infection in the UK is leveled out, but that's just on the basis of the last few days. But I think here we'll need another week or so. The UK in some ways follow, because we've had such a very large vaccination rate, and this variant seems to be more evident here than in other countries, at least from what I can tell. So I think by the beginning of the second week of June, when the British government will decide about opening up more, we will see pretty clear signs whether this new virulent spread is causing a lot of damage or not. But we'll have to just keep having an open mind, as one always has to do about a lot of information.
So, Jim, what do you think that the market should be looking at? I mean, apart from inflation, which I imagine is 90% of their time, if not like 100%, is there something else? Is it, not volatility, but liquidity that we should worry about, or something else that makes you uneasy about the summer months?
Well, I tuned in to catch the intro to you, or the end of the previous discussion and the intro to yours, that it is quite clear within sectors of the equity market things have got a lot more volatile, and if we see a fresh bout of nervousness in the bond market, then that's going to create issues about liquidity as well as more volatility, because it is the time of year that we go through. Nobody's ever fathomed out quite why you have this regular thing every late spring going through the summer. But I have to say I have some sympathy with it this year. And even though the overall S&P index managed to eke out a small gain in May, it probably didn't feel like that to many managers because it was just so volatile. And we've got a tricky couple of months coming up, because it does look to me as though these indicators are going to be extremely strong around the world, and marginal central bankers will be shifting from being as friendly as they were, and it's not impossible that they might start to send messages about some sort of preemptive, they wouldn't call it tightening, but removing of the scale of liquidity. So it's going to be challenging. But at the end of the day, focusing on measures of inflation, and as I think I made reference to in the piece you cited, something that I believe for a long, long time, that the 5-year University of Michigan inflation expectations survey in the US is highly powerful in terms of its durability and its true reliability. So I'm going to be watching that.
Yeah, I remember actually saying it last time, so we paid special attention to it. Jim, so I came in and actually our head of economics reminded me that you coined BRICS 20 years ago, which made me feel really young. Leaving that to one side.
On my forehead.
Do you think your analysis has held up? Is there something that, that has structurally changed actually in how we should be looking at them?
Well, obviously the second decade for Brazil and Russia has been a bit of a disaster. So as I occasionally joked about, maybe it should have been called IX, because those two haven't fulfilled what the scenario painted could happen. That said, if you look at the aggregates, because China dominates it so much, the reason why the whole concept became so popular is because we said that by the middle of the next decade, the BRICS could become bigger than the G7. And that's still possible because of China. And despite endless dilemmas and challenges and these waves of really bearish mood about China, China keeps sort of, I was going to say, sort of plugging away, but it's obviously more than that by global standards. China looks like it's going to eke out something close to 6% growth this year. And that's more than we assumed as part of the BRICS story would happen this decade. So, and as you touched on also, the exchange rate is very strong. So in dollar terms, that's translating into an even bigger rise of a share of global GDP. And India, despite its enormous cyclical problem, looks like it's coming through the worst of this infection rate and will probably bounce back just as quickly as everybody else. So, is it still the same way to describe the thing? I mean, I can't be the judge as well as the theory creator. That would be a conflict. But feels to me everybody talks about it still, and the BRICS political leaders meet all the while, and these guys collectively have an increasingly large share of global GDP. So, and as we'll see when it comes to global governance, which is where the idea all came from, the G20, which includes all of them, because it includes all of them, is a lot more relevant for truly global problems than is the G7, which the UK is about to host.
Wonderful. Jim, thank you so much. Jim O'Neill there of Chatham House stays with us. We'll talk a little bit more maybe about BRICS or IX, and we'll talk maybe about football as well. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later on in the program, we discuss the Italian reopening with the head chef of the 3 Michelin star restaurant Osteria Francescana. He's Massimo Bottura. He's coming up shortly. But up next, we continue our conversation with Jim O'Neill. If you have any questions for our guests, you can just IB plus TV Go. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now we're back with Jim O'Neill from Chatham House. We're talking about BRICS. We're talking a little bit about China. Jim, when you look at China and actually also the adoption of a possible digital yuan, that could be a game changer, not for now, but longer down the road for China. How do you see this, China-U.S. relationship developing?
I think it's going to continue to be tricky. It's quite interesting to see in the past week the Biden administration picking up the threads of Trump administration focusing on the source of COVID, for example. That's not something I think many of us would have expected. And pending how that goes, that in itself obviously could cause a whole new level of friction. I find myself thinking that it's probably in China's interest to now be more open about the inquiry, given the frequency that this is coming back. Because if ultimately it was discovered by involuntary methods on China's behalf, that there was some source of it away from this animal market, then that would not be great, to put it mildly, for China. So. How that progresses in itself, on top of everything that's there beforehand, is going to be tricky. All of that said, if you go back to the pure narrow economics of it, if you look at the way China's conducting its monetary and fiscal policy relative to the rest of the world, and an incredible contrast to 2008 coming out of that mess, China's being almost Swiss-like in its caution, which one would imagine longer term is probably pretty good for all things China relative to the rest of the world, I would say.
Jim, we also heard from Emmanuel Macron asking if the U.S. is still spying on EU leaders. I mean, that story, is it expected that, this has to do with Denmark and the fact that maybe they were helping or facilitating the spying of Angela Merkel? Is this something that we should not be surprised by?
Well, I only ever worked in the Treasury in my extensive 17 months in government, not in the Foreign Office or the security services. But that said, I would guess the reality is many countries are constantly spying on each other in different levels of intensity. So, I can't imagine that the French don't spy on other countries that are allies of theirs either, to be honest with you. But there again, let me quickly add, what the hell would I know about that?
All right, you know a lot about football. Did you spend much of the weekend watching football?
Well, in Westfield Shopping
my
Centre,
team is doing
Shepherd's
so
Bush,
poorly,
and
got
we're causing
humiliated
carnage.
in the sort of lower class European trophy last week. The only consolation we got from this season is that A, it's finished, and B, Manchester City didn't win the trophy that really matters. So there are endless funny cartoons going around about how Manchester City can't. Hey, get this on Bloomberg Live. There's a fantastic thing from Patrice Evra taking the mickey out of Liam Gallagher about City not winning the European Champions League. It's very funny.
Okay, we'll get that in the next 20 minutes. I mean, does your football does Man U need a new manager then?
Oh, that's a bit harsh on Ollie. Manchester United needs new owners. Manchester United needs new owners, better purpose, and a connection with someone. I think I've discussed with you before, certainly written about the past 2 months. It epitomizes the need for in some parts of business to have profit with a purpose. The Manchester United machine is driven purely by the motive of profit, and you see the negative sides of that unfolding as the years go by, and the resulting dissatisfaction from Manchester United fans is only too evident to see, and you see some of the consequences of it playing out on the pitch. One of the key members of the family is supposedly meeting with a fans forum of United fans later this week, and if there's only a token gesture of a shift shown, then we're going to get more disruptions because United fans have had enough of this style of ownership. And beyond the sort of amusing side of us talking about it in a football context, this is highly relevant to the broader issue of how business develops in coming months and years as we come out of this pandemic, because we need to make sure that there's more winners from the way capitalism is being evolved, not just from those that can sort of organize a sort of oligopoly or monopolistic type control.
Jim, thank you so much. Always fun, never dull. And you even have me speaking about football. Jim
nice
O'Neill,
to see you.
Chatham House Chair, as always, joining us on a number of issues, including football. Now, coming up, China's yuan is on a tear, reaching its highest against the dollar for 3 years. Now, China is taking measures to slow the run for the first time in more than a decade. We'll have the latest next. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's quickly check on the markets because there's quite a lot going on. Coming up, we speak with Enda Kern about yuan and some of the movements there that we saw. The other big one, of course, today is OPEC. Now, OPEC has, as always, the ability to move a lot of the emerging market currencies depending on what they do with oil. If I'm looking at the European stock 600, they're gaining some 0.5%. I look at cyclical shares and they're actually up. Again, it is the week where the European Union plans to lift all quarantine requirements starting in July. Also, pound jumping to a 3-year high as traders cheered the rollout of vaccines in the UK. Now, he's a man who runs one of the world's best restaurants. He has taken Italian cuisine to new heights, and he joins us to talk about the Italian reopening. Coming up, we speak to the chef patron at Osteria Francescana, Massimo Bottura. If you have any questions for him, just IB plus TV Go. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Global stocks start a new month near record highs, but could concern over inflation force central banks to take their foot off the gas. Italy eases restrictions in the latest big test for Mario Draghi. World-famous restaurateur Massimo Bottura joins us to talk resilience in hospitality. And will China's moves to rein in the surging yuan shift the dial for investors? We get the latest on PBOC policy. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China is forcing its banks to hold more foreign currency in reserve for the first time in a decade as it attempts to brittle its surging currency. The yuan has gained 13% against the dollar since last May, fueled by China's economic bounce back and its high-yielding markets. Well, joining us with the very latest is Enda Kern, our Bloomberg Chief Asia Economic Correspondent. Good morning to you, Enda, or good afternoon for you. What's the significance of the PBOC's move on the yuan?
Well, Francine, I heard it described as a shot across the bows of the banks here. It's not intervention in the yuan per se. China isn't directly intervening to bring down the strength of its currency or anything like that, but it's a technical measure. They're asking banks to hold aside now 7% of their foreign exchange in reserve. That's 2 percentage points higher. It's the highest since 2007. And what it means in practice is that it will take dollars off the table and put some downward pressure on the yuan. As you mentioned, the yuan has been on a tear against the dollar in recent months, and while China isn't explicitly intervening, they certainly want to send a signal that, look, this one-way bet can't go on forever, that they're not especially happy with where the yuan is, and that at some point it's going to have to come back down.
How effective and is this move going to be?
Well, it's quite a technical measure. A lot of analysts this morning were saying that, look, it's not going to be a game changer. It will take steam out of the yuan at the margins. You know, will require banks to keep money to one side. It's nothing like the shock that we saw back in 2015, for example, when they shook up the trading mechanism for the yuan. And China also will have to tread a bit carefully here because, you know, they're trying to send a signal to the world that the financial markets are wide open, they welcome foreign capital, they are committed to freeing up and liberalizing the currency. So they don't want to be seen to be on the global stage as deliberately now stepping in to manipulate their currency per se, to help exporters and the like. And they also have a practical issue in that China is importing a lot of inflation at the moment on the commodity side of things, a lot of tradable prices, and a strong exchange rate helps keep a lid on that. The flip side, of course, is that it does hurt profits, especially for smaller exporters in China as well. So there's no doubt China has a lot to balance when it comes to yuan's exchange rate. This particular move is somewhat modest, but it could be a signal of keep an eye on this space and see what other kind of policy levers the government does pull over coming months, Francine.
Enda, thank you so much. Enda Kern there, Bloomberg's Chief Asia Economic Correspondent, joining us with the very latest on what could be one of the biggest stories of this year and beyond. Now, as the rules of economics are rewritten by COVID, one of the places that's most felt is in the labor market. Massive job losses, furlough schemes, and flexible working are just some of the themes that emerge from the past 18 months. This week sees the World Economic Forum hosting its Jobs Reset Summit, where leaders will examine the future of the way we work. Well, joining us now is Sadia Zahidi, World Economic Forum Managing Director. Sadia, I'm also looking forward to the forum because I'll participate, I think, tomorrow with a wonderful panel. And this, is the biggest headache as we get out of our, into the recovery phase out of the pandemic. Is actually many people have lost their jobs, and it's unclear what the jobs of tomorrow will be. Is this actually probably the most common policy mistake would be leaders not retraining their workforce to make sure that they can have the jobs of tomorrow?
I think this is one of those areas of challenge where there is remarkable consistency, regardless of who we speak to, as to the nature of the problem. So we just launched today our Chief Economist Outlook, and the area that they are most concerned about is long-term economic scarring due to bankruptcies as support measures are pulled back, and second, long-term scarring in the labor market, all of that leading towards that K-shaped recovery. You get a very similar picture when you speak to, for example, chief human resources officers or labor economists, exactly the same worry. So the good news is we know what the problem is, but it is going to take more than reskilling. Reskilling and retraining is going to have to be a big part of the solution. But the second thing that we're going to need is a medium-term focus on actually investing in the jobs of tomorrow. I think a completely passive approach on the part of policymakers is unlikely to work.
What do you see, Sadia, as the jobs of tomorrow?
So we've been mapping out across 7 big sectors what the jobs of tomorrow are likely to be. One big area is care jobs. You know, a big win-win for society. These are jobs that are needed because of demographic challenges and changes, but these also happen to be big areas of mass job creation. What we need is higher wages, better certifications. A second big area is the education sector. So reskilling itself is likely to provide a massive job creation opportunity. A third is, no surprise at all, the digital economy. And within that, you've got sort of a whole set of areas around cloud computing and AI and machine learning specialists and data analysts, just a massive area of growth. And then there's a number of others that relate to a new kind of customer service, new kinds of marketing, new kinds of HR-related roles. All of these are big job creators. And then, of course, not surprisingly, the green economy and all of the jobs associated with that. What governments will need is to ensure that as their stimulus packages try to build these markets of tomorrow, there is an equal effort on building the jobs of tomorrow. And that requires a slightly more directional, slightly more prescriptive approach than we currently have to reskilling and upskilling markets. For those that are already inside companies, this is going to be fairly easy to do. But for those that will be wholly displaced and that will be looking for new opportunities, there's going to need to be more guidance provided by governments.
Sadia, is there a government or a region that actually gets it more than others, that are doing this right and are looking at the transition the correct way?
No, Francine, you're not going to be surprised when I give you the Nordics as the example, right? So these are governments that have for quite a long time put human capital and sort of the software of the economy at the heart and at the center of what needs to change if their economies are going to be ready. They are, again, doing a fairly good job of using the sort of basic flex security system that exists to, on the one hand, have a relative level of flexibility on the labor market and to combine that with security for workers and to try to preserve work and workers and their income rather than to simply preserve specific jobs. They're again doing a fairly good job of managing the shift that's currently underway, but across the developed and the developing world, this is going to have to be a set of practices that are embraced by everybody.
Sadia, I mean, I know a lot of the forum will also be not only on the scarring and kind of these new jobs that are being created, but I guess the work from home or the flexibility in work and approaches. And do you think that's something that will change the way we live and work because of the pandemic, or is there a chance that actually even our economies go back to the way it was pre-pandemic?
There's an interesting bifurcation going on at the moment. In a lot of the white-collar workforce that has been able to work from home over the course of the last year, the big debate is really about what level of return to the office is going to happen. Is it going to be full return to the office? Is it going to be fully stay working from home in a very flexible way? Or will it be a hybrid? The large majority of companies, particularly in Europe, are ending up in that hybrid space with at least 2 to 3 days of minimum in-office presence. The other part of the workforce is really those that have not been able to do much of their work without in-person interaction, who over the last year have been sort of bearing the brunt of the front end of this health crisis, or have had to be essentially out of work. Now, that's where you're seeing some of the most interesting developments. New jobs are being created, but workers are not necessarily ready to rush straight back into work. In part, that's because of the support they're currently receiving. In part, it's because vaccination programs are not complete. But in part, it's also because many workers are asking themselves, is this worth it? And they might be looking for more of an opportunity to either reskill away from that in-person workforce, or to see if their employers are going to offer them higher wages. And that's where you're going to see that upward wage pressure in some of that frontline work.
Sadia, I know you've done also a lot of work on economic development. Are we looking at a more balanced and equitable future for countries and also populations within countries? Or, again, is it going to be the same old mess?
You know, much of what we've been talking about so far is about that within-country K-shaped recovery. It's about the rising inequality. For the first time in about 20 years, you're seeing that the middle class is shrinking, and you're seeing that poverty levels are rising. But this is also playing out at an international level. There is, again, for the first time, the risk of a major divergence between developed and developing economies, rather than the kind of convergence that we've been aspiring to. In part, this is pre-pandemic trends. It's because that old model that was on the basis of competing with cheap labor or aspiring to a sort of manufacturing-based development model, that's been going out the window for some time, and the pandemic has just made it worse. And so those economies will have to think very differently about some fundamental investments in education, on digitization, on human capital build out within their economies, and using a very different growth model in the future. But some part of this is really because of the pandemic. These countries don't have the fiscal room to have provided the same kind of support to their workers, to companies, and to have had the same kind of healthcare response. And that is where measures that will provide vaccinations to developing economies and measures that will provide a lot more support so that they can shore up their economies will be critical. That is the only way to avoid the risk not just of inequality within countries, but also across countries.
Sadia, thank you so much. As always, Sadia Zahidi there, the World Economic Forum Managing Director. Now, he's a man who runs one of the world's best restaurants. He's taken Italian cuisine to new heights, and he joins us to talk about the Italian reopening. Up next, we speak to the chef patron at Osteria Francescana, Massimo Bottura. If you have any questions for him, just IB plus TV Go. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data. How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics, and also a little bit of restoration today. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, one of Europe's largest economies is finally reopening. From today, restaurants in Italy's low-risk zones can serve customers indoors for the first time since February. Our next guest may be one of the many people celebrating the reopening of Italian hospitality. Well, joining us now is Massimo Bottura, chef patron and owner of Osteria Francescana. Over the years, Massimo has collected a range of accolades that place him among the world's best contemporary chefs. After entering the prestigious 3 Michelin star club in 2012, Osteria Francescana Francescana also won the World's Best Restaurant Award twice, in 2016 and 2018, becoming the first Italian restaurant to do so. Now, in 2011, Massimo himself was also voted amongst his peers as the most innovative chef around the world. Massimo Bottura, welcome to Bloomberg, and he's also great energy when speaking to you. I could not be more excited to having you on the program. Massimo, how excited are you?
Thanks for the presentation. Actually, last year we got also the 4-star, the Michelin Green Star for the sustainable restaurant. You know, that to me, it's a very innovative, but in the perfect period, you know, to get that kind of star, because we need aesthetic close to the aesthetic approach to food.
Yeah, and this is because you have always actually, you know, I don't know if it's slow food cooking, but you've always tried to source things really around where you serve customers. How excited are you of having customers back in your restaurant, inside, indoors?
As the first day of school, you know, you imagine, we are all like, oh my God, what's going on? You know, I was very focused during this period to use this precious time, because I have to think always positive, and I'm responsible for 150 people here in Modena, with between Maria Luigia, Francescana, Franceschetta, Cavallino, Food for Soul. So we are 150 people, the family, and I was responsible for everyone. So I had to take care of the apartments, I had to take care of food, I had to take care of the salary, because you know the Italian government is like kind of struggling, especially with companies they think are very healthy and things. So I took care of everything. So I stay extremely energetic, try to involve
engaged.
Engage all my team in creative exercise.
So have you thought about, I mean, I've seen a lot of your recipes also on social media. I'm sure you kept engaged also with, you know, some of the new things that you will bring to the people that have booked. But is there a new way of doing business in hospitality because of the pandemic?
Yeah, of course, you know, the whole hospitality changed. We need to be more focused on the reality, the real thing that is about restaurants. So restaurant means restore the soul of the people. So first thing is like a big smile, hug people with in a very warm way, and make them feel home. In Maria Luigia, we did this, and you know, our country you know, we want everyone who come and visit us to feel home, and it's home away from home. So it's what we want to do. And but for Osteria Francescana is a different approach. Osteria Francescana, we opened the reservation at 10 o'clock today for December.
Yeah.
We already fully booked. So it's like, it's different, you know. I knew it was something that we had to just start again. And but the thing is, we keep evolving. And now we have a new menu that starts today called With a Little Help from My Friends, dedicated to Sgt. Pepper's Lonely Hearts Club Band, but also to all the historic Italian gastronomy from the 50s till now. And it's gonna be explosive. You are the first one who knows about this, because I didn't tell anyone.
I mean, I don't know if it's the pictures we're seeing, but I have to say the newsroom and the people watching are pretty excited to also have this sneak peek about, you know, what the chef is proposing. Massimo, when you look at how your industry will adapt and how difficult is it, are you going to have less people inside? Do you have to take more measures and precautions? Or does it actually, you know, do people feel comfortable enough just because of some of the fantastic things that you were just talking about that really no one else is doing?
Yeah, no, for us it's like, it's always been an approach to gastronomy on quality and not quantity. That problem will be for big restaurants, no, big numbers. For us it's always been, at the top we want 30 people, 30 guests, as we do in Casa Maria Luigia, as we do in the other restaurants. So it's not about the quantity, but the quality. The quality of the ingredients, the quality of the idea, the quality of the service and the hospitality, and the power of beauty. We try to create beautiful places, but not just for the 3 Michelin star restaurant. Even our project Food for Soul, or Feeding the People in Need, it's about beauty, because our soup kitchen they have one thing, full of art, architecture and design to share with everyone.
Massimo, actually, I remember visiting one of the soup kitchens, and some of the things that you've done has been pretty extraordinary. Do you worry that, the legacy of the COVID crisis will be more people in need, and actually even more restaurants closing down? Is it the restaurants that just couldn't cope, or is it restaurants that would have closed down anyway?
I think most of them, they would close down anyway. Some people in need, yes. The request for people coming to Refettorio, for my personal experience, probably they double. There's a lot of this class that was like, they lost the job, workers. It's gonna be trouble. There's gonna be trouble in the moment the Italian government is gonna reopen the possibility for the companies to fire people, because there's an excess of workers, and that's gonna be trouble, I think. But as we always did, I'm extremely positive on try again and solve the problem through our managing the irrational, as we always did as Italian.
And Massimo, are you fully booked for all your restaurants? I'm not asking for a friend, although I could be. But actually, are you suffering from tourists not being able to come to Italy at the moment because of various quarantines?
Yeah, actually, we have a very high percentage of booking. But we keep, we keep doing. Osteria Francescana Via Stella is something that is completely fully booked till 30th of December, because last day of the year we didn't open yet. We have Osteria Francescana at Maria Luigia. That is my jewel. This farm that I rebuilt. And I create 12 rooms, 2 apartments, a private villa. During this pandemic, I didn't know what to do with all my energy, and we did this. And
so we have a new shop. Massimo.
Yeah.
So great. And actually, so many viewers are asking, so there you go. Now we have the answer. Call Massimo and get yourself booked in. Massimo Bottura, as always. What a great pleasure
in Maria Luigia,
to speak to you.
In Maria Luigia, we cook in front of the people. So we broke the walls. In the world, where everyone wants to build walls, we broke the walls and we decide to cook in front of the people. So the guests are part of the experience in the evening. So it's unbelievable. It's an incredible feeling,
Massimo,
because in the meantime, we are plating. People are coming and join us with telephones, with cameras, and everything. And they are part of all this. It's amazing. It's a new
Massimo,
approach.
it's wonderful.
Thank you.
There's like a politics parallel. I need to get you back on. Massimo Bottura there from Osteria Francescana.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Well, European stocks actually on the rise. I'm looking at the European stock 600 gaining some 0.9%. Cyclical shares higher. OPEC also oil surging on the back of OPEC later. This is Bloomberg.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
I feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is not the time to worry about inflation. The enemy's still there.
You can't forecast these things. And even if you could forecast where inflation is, you don't know what the effect's going to be on the stock and bond markets.
We're not going back to the 1970s, but it's just so clear that this is more than temporary.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning from London, Berlin, and New York on this Tuesday, June the 1st. We're in June. Our top stories today. The British pound takes a breather while sterling backs off a bit after rising to a 3-year high. Traders still betting the UK's economy will take off as more people get vaccinated. Beijing steps on the brakes. China makes its most substantial move yet to keep the yuan from getting stronger. And say goodbye to the oil glut. Brent rises above $70 a barrel after OPEC and its allies predict the global market will tighten up. We'll talk with the head of the International Energy Agency, Fatih Birol, shortly. Now, there is quite a lot going on in the markets also because we took a breather yesterday. So we look at pound movements, we look at dollar movements. And Kaylee, of course, underpinning all this is not only inflation, but what OPEC does will maybe filter through that conversation as well.
Yeah, of course, commodity prices have everything to do with inflation, Francine. We will await that supply decision, which could come today. And of course, we get a slew of economic data here in the U.S. throughout the week as well. Of course, it is the first trading day of June, and where that left us in Asia was mostly positive. The MSCI Asia Pacific Index at its highest in more than a month. Even though Japanese and Australian equities were just a touch softer, the outperformance was really led by Hong Kong, with the Hang Seng up more than 1 percentage point. Of course, as you were saying, Francine, really interesting story in China when it comes to the yuan, taking a bit of a firmer hand, trying to rein in that rally by lifting the reserve ratio for foreign exchange holdings for banks to 7%. And after that, the yuan is slightly weaker against the US dollar, sitting at 637.48. Also in foreign exchange, I would note the Aussie dollar is stronger against the US dollar, even if off session highs after the central bank left policy unchanged. As for what the picture looks like here in the U.S., futures are pointing to a firmer open to start the month. We are up about 0.4% on S&P E-minis, and we're seeing some selling in the Treasury market, with yields moving higher by about 2 basis points on the 10-year to 1.61%. Of course, it is OPEC day, and ahead of that, WTI crude up 3 percentage points above $68 a barrel. That is the highest since October of 2018. Even if more supply could be coming onto the market, the fact that the cartel is saying that that tighter global market is taking shape, that supply glut going away, seems to have traders optimistic. And then, of course, coming off of a long weekend here in the U.S., we thought that may mean incredible volatility for Bitcoin, and we didn't really see that happen. It actually rose Sunday and on Memorial Day yesterday, that Monday. It is just, though, slightly down today to below $36,000, Matt.
All right, so a little bit of a breather for Bitcoin as well. You guys took breathers yesterday. I was here. Of course, European markets continued to trade, and it looked like at the beginning of the session today that we were going to see a drop for the FTSE, and even U.S. futures were down. That's turned around a little bit. We got a ton of economic info out of Europe. We started out this morning with German inflation ticking up higher than had been estimated. Now we see European inflation just coming out, also higher than had been estimated, rising to 2%, a solid 2% from 1.9%. And Italy boosting its GDP forecast now to actual growth rather than contraction as the economy there reopens. That's something that we're going to talk about throughout the program. Take a look at the stocks today. Markets are climbing, and the DAX is rallying up more than 1% right now. So German markets a little bit stronger than the rest of Europe right now, but we see gains in France, in the UK, on the Iberian Peninsula, Everybody up today. I also think it's interesting to see the euro gaining a little bit of ground back on the pound. If you look here, you can see euro pound at 86 pence. I keep very close track of this because, as most people know, I've been waiting to buy this used Ducati S4 RS in Sheffield, and I need my euros to gain a little bit more strength against the pound before I can make that deal. A couple months ago, it was down below 85 pence. So as we gain ground, I'm closer and closer to coming over to the islands and picking up that bike. You all see Volkswagen. So much news around Volkswagen, Francine. You've got Business Insider reporting that they're close to making a deal with their former CEO, Martin Winterkorn, on clawing back some compensation after the diesel scandal. You've got Handelsblatt reporting that they're thinking about an IPO of their battery unit. And then you've got Reuters saying that the Porsche and Piech family would take big stakes in Porsche in case of a Porsche IPO, no matter how unlikely that is at the moment. So a lot of news around Volkswagen, and they're the biggest gainer on the DAX index right now.
I would love it, Matt, if you went to get your motorcycle, because I still don't understand the tax system. So if you get it here in the UK and then drive it back, presumably you don't get taxed. But I bought coats in France and then get taxed more than if they were shipped to the US, and other times I didn't pay tax. I think I would get taxed. Unclear exactly what happens.
I think the thing is, I would drive it back myself, obviously, but then I would feel guilty. I wouldn't want to get caught. You don't want to be a tax cheater, especially in Germany. It's really frowned upon. So I would have to announce it, declare it. I live on the honor system, as you know, and then I'd have to pay like 20%.
Yeah, more than tax cheater. I just don't 100% know what the rules are, and a lot of customs have not figured out since Brexit. So we'll look at deeper exactly what the right way to pay tax is. Now look at what else is ahead, apart from the tax debate and cars being moved from the UK to Germany. NATO foreign and defense ministers meet virtually today in a summit chaired by the Secretary General, Jens Stoltenberg. The BOE Governor, Andrew Bailey, will speak at the Reuters Global Responsible Business Conference. Also, the Economic Club of New York hosts the Fed Governor, Lael Brainard, for a webinar. And finally, OPEC Plus meets to review oil production plans. The alliance is expected to continue reviving output, which is why we're looking at, of course, the price of Brent and WTI almost on an hourly basis. Now, uncertainty continues over the outlook for the pound. Sterling now pulling back after sitting around the strongest level in 3 years. That's as traders make bets as to how much traction the vaccine program will have on the economic recovery. Well, joining us to discuss this is Danny Berger. Danny, if you look at what's driving the markets, partly it's vaccination, but partly it's maybe dynamics with dollar.
It absolutely is. And you're so right. And that's why it's so difficult to get this clean narrative, because it doesn't only matter what happens in the UK, the rate story, the economic improvement story. It's really important how that fares relative to the rest of the world, because, of course, this idea of a stronger pound, which around here was trading at a 3-year high, had to do with the idea that the BOE would move sooner than the Fed, would move sooner than its other developed market peers. Of course, that story, we don't know certainly that that's going to be the case. Yes, the economic outlook is improving. The vaccinations are gathering pace. But MPC members, they really are just laying out scenarios at this point, saying, okay, if employment looks really good, then that's when we get perhaps earlier tightening than had been expected. But we don't know that that's going to be the case. Now, the economic optimism picture at its highest since 2016 in this survey of businesses. But you'll note it really happened, that plunge, that pair in gains from the pound happened when markets opened at 8 a.m. When you finally get cash trading in equities back in the market, people are finally back from their holidays. So it really was in the most voluminous part of the market trading at the open that we saw this fall in cable. So, I mean, it really is just going to continue to hit these resistance levels despite the fact that the trend is higher and the economic picture is brighter, Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. And let's keep the conversation on foreign exchange, because China is forcing its banks to hold more foreign currency in reserve for the first time in over a decade. That's as the PBOC makes its most visible attempt so far to rein in the surging yuan. Let's get more from Bloomberg Chief Asia Economics Correspondent Enda Curran. Enda, what's the significance of this move from the PBOC?
Well, it's something of a shot across the bows. It is not direct intervention by China's central bank. They don't want to be seen to be doing that. They don't want to be accused of deliberately cheapening the currency. But nonetheless, they are clearly concerned that the strength of the yuan has been on a tear now against the dollar, 3-year high. And what they're doing is fairly technical. They're telling banks, look, you must keep 7% of your foreign exchange in reserve. That's 2 percentage points higher. It's actually the highest since 2007. And while that won't be a game changer for the yuan, it does mean that it will put a bit of downward pressure on the currency, but the signaling effect is what's even more important here. The central bank is trying to tell traders and tell the world that, look, this one-way appreciation tear that the yuan has been on cannot go on forever. It will come to an end at some point. The central bank clearly doesn't want to step in and intervene. China's trying to sell a message that it's welcoming global capital, that the markets are somewhat open for business. But at the same time, it's reminding everybody who's in charge here that they will keep an eye on where the levels are. And clearly they have some thresholds that they don't want to cross. So, you know, as it was described earlier today, it's something of a shot across the bows. It's not a game changer for the yuan, but it could be the first step in other policy steps that will follow over coming months, and it's certainly going to be a space to watch very closely.
All right, Enda, thanks very much. Bloomberg's Enda Curran there talking to us about what's going on in China. Now, in terms of global oil, Brent is climbing, NYMEX is climbing as OPEC Plus prepares to meet in Vienna to discuss supply policy. Will Kennedy joins us, Bloomberg News executive editor for energy and commodities. And Will, we already know that their view on supply is more bullish, I guess, in price terms in the second half.
That's right. I think that most people's calculations see the oil market tight and tightening, that the call on OPEC oil will increase in the second half of the year as demand recovers around the world, driven by a recovery from the pandemic. So in terms of today's meeting, I think that means that they will rubber stamp a decision to put more oil into the market in July, about 800,000 barrels a day, some from Saudi Arabia and some from the rest of the OPEC Plus coalition. So that will almost certainly happen at today's meeting, continuing the pattern they've set over recent months of slowly putting supply back into the market. The bigger question, and what we'll be looking for, is what happens after that. At the moment, they're meant to hold production steady until early next year. But given how tight the market is, they may want to look at increasing production more. The big unknown is Iran. What happens at today's Iran talks, and when does that Iranian oil come into the market? That will be also weighing on discussions today. So we'll be looking for any comments on that.
Yeah, definitely a big question mark on the Iran issue. Will Kennedy, Bloomberg News executive editor for energy and commodities, thank you so much. Now I want to take a quick look on some stocks moving in pre-market trading here in the U.S. And one big mover to the upside is Cloudera, the software company. This is on reports that KKR and CD&R are looking to take the company private at a $4.7 billion valuation. That's about a 24% premium to the last close. Shares are higher by about 18% in early hours. I also have to talk about one meme stock that has been on a tear. AMC was up 116% on the week last week. Reddit traders coming in and buying, and that seems it's continuing this morning. The stock up 10% in pre-market trading. One mover, though, to the downside is CureVac. It did release positive results from its COVID-19 vaccine trial, but says it has to continue in order to get more data. Apparently, investors were looking for a little bit more positive information out of the company, and that stock is down about 4% before the bell as a result, Francine.
Yeah, we're always after more positive news on anything to do with vaccine. Thank you so much, Kaylee. Now, coming up shortly, Christian Nolting, Deutsche Bank International Private Bank Chief Investment Officer. I know we'll ask a thing or two about vaccines, of course, how that moves, the recovery phase. And then a little bit later, we'll also discuss OPEC and oil with the IEA Executive Director, Fatih Birol. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line.
Added more than $24,000.
Compare financials.
Average new house.
Find people.
Lumber prices are expected to
Analyze
stay
markets.
For months to come.
You can answer phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kaylee Lyons in New York. Now, I got a little bit deeper into what we've seen happen with sterling here. This is a long-term chart going back 5 years, and what it shows you is that we're getting closer and closer to those 2018 highs, which were 143.77 in dollar terms. We've come off a little bit today, but we've been making a push over the last few trading sessions. So definitely one we're going to be watching very closely. And then, Francine, I was digging into the tax implications of bringing a used Ducati across from Sheffield back here to Berlin. It looks like I may have to pay 10% duties, customs, plus 21% VAT, which makes me think, you know, forget about it. I'm not going to do that.
Well, there you go. Save money. Save money. It's the German way, Matt Miller. I mean, it's a great conversation. Actually, I mean, we need to look at duties because, for me at least, it's unclear with also some, certain exportable goods, and it's a really interesting conversation because it affects everyday life. Now, Christian Nolting, I don't know whether he's thinking of shipping, some transports, whether it be Ducatis or something else, but he is looking at the markets. He's Deutsche Bank International Private Bank Chief Investment Officer and Head of Investment Solutions. Christian, thank you so much, as always, for joining us. First of all, how difficult is it to understand exactly what the pandemic and the huge stimulus does, not only for inflation, but for the world economy, for business, and therefore for equities?
Yeah, well, I think the first important point is to understand we had this massive drop and now, fortunately, a substantial recovery with vaccines going ahead. I think we need to look through a little bit, right?
In
What's
dollar
after
terms,
this? So
we've
you
come
see
off
that
a little
drop,
bit today.
And that spike, and that's true for growth, and that's true for inflation. I think to look through this is not very easy, but you need to have a clear picture about this.
So what kind of inflation do you expect Germans to be willing to put up with, Christian? Normally, people in this country, culturally, they're very much afraid of inflation, but it looks like things have really changed. I mean, getting rid of the black zero, getting rid of the debt brake, they're ready to borrow and spend. And if the Greens come into office, that could get even more pronounced. What is your expectation?
Yeah, first of all, you're right. Inflation has always been, if you talk to clients, to people here, is the big fear. I think that has changed a little bit. Obviously, Germans are also ready to have more exposure to equities, which is remarkable, I think. We have not seen this for many, many years and decades. I think from an inflation picture, indeed, we could, let's say, expect that Germans are a bit more relaxed about inflation because they also see that financial repression, which is there, is still an issue, and I don't think that will go away, by the way. From a spending perspective, yes, if in September we get a new government where the Greens would be part of, which is quite likely looking at the polls right now, maybe their spending, yes. It's still to be expected that the debt brake is coming back. I've not heard that this will go forever. It's just intermediately, let's say, withdrawn. But at this point in time, I still think it could come back.
So, Christian, if you're looking for a little bit of protection against inflation, where do you do so? We're coming off the best month for gold since last July. Is that a good hedge here?
Well, we still like gold as a hedge, but I won't see a lot of price appreciation in gold for the time being. I think there's also quite some correlation to the currency side, if you look at dollar, for example. And we've seen gold also coming down because of the environment getting better. I think in the tough days of last year, gold did have a quite good, let's say, inflation protection view. I think from a perspective of the portfolio, I think equities in a way are positively correlated really to inflation. That's something to look at. And then maybe you put a hedge on the equity side as well. So you build some exposure there if you don't have. I think that's quite a good hedge. And then you have, let's say, tips. You can have inflation protected bonds as well. So that's something to really put into the diversification of a portfolio from my point of view.
Christian, is there a sweet spot for the price of oil for, not only the world economy, but actually markets?
Well, it's very interesting to see what the OPEC now is really deciding on. From my point of view, they will increase production and reduce the cuts a little bit, but not massively. And that's why I think oil will stay at quite high levels, with demand also coming back in the second half. I think that's what's to be expected. And from that perspective, there is a link into inflation, because inflation expectations are still built substantially on oil prices. So if we see oil prices around these levels, I think it's quite a sweet spot for markets, I would say. You see some inflation coming up. It doesn't force the central banks to immediately act. If oil prices were, let's say, 10, 15% higher from here, I think we are out of the sweet spot. And then there could be discussion on higher inflation, central banks acting faster, and that could be out of the sweet spot from my point of view.
All right, interesting. Christian, thank you so much, as always. Christian Nolting there, Deutsche Bank International Private Bank Chief Investment Officer and Head of Investment Solutions. Now, coming up on Bloomberg Technology, Mike Novogratz, Galaxy Investment Partners Chief Executive Officer. Look for that at 5 p.m. in New York, 10 p.m. in London. He's been really pretty fantastic talking about Bitcoin and cryptocurrencies. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Friday is Jobs Day on Bloomberg Television. After April payroll numbers hit below estimates, investors look for a rebound in the labor market. The May Jobs Report, Friday morning on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And Iran has produced a record volume of highly enriched uranium that could be turned into fuel for a nuclear weapon. That's according to the IAEA inspectors. Their report comes as diplomats try to revive an agreement to rein in Iran's nuclear program. Talks in Vienna are now in their 8th week. France's President Emmanuel Macron demands to know if the U.S. is still spying on EU leaders. He was reacting to reports that American intelligence monitored Germany's Chancellor Angela Merkel and other European politicians with the help of Denmark. The Danish are among the U.S.'s closest allies in Europe. In tennis, women's star Naomi Osaka has dropped out of the French Open because of a dispute over mandatory press conferences. Osaka said in a social media post that she has suffered from depression and social anxiety disorder. She says that taking part in press conferences makes matters worse. Osaka is ranked 2nd in the world. And Bank of America plans to bring all employees in Hong Kong and mainland China back to the office by the end of June. That makes the bank one of the first global lenders in the Asian financial hub to push for a full return. B of A will issue a 30-day notice period as well as return to office training for all staff. And of course, here in New York, top managers are returning to the offices today, June 1st, Matt.
Yeah. Returning to the office today. Everything's opening up, it seems. You know, we've got Italy's opening up. I'm sure you guys have been partying like crazy in London and New York. Now, Germany, in Berlin, the Senate today is voting on reopening indoor dining as well as gyms. I'll be doing one, but not the other.
I have a guess which
You know
one
what, the thing is that if you go back to the office or go back to a restaurant, there's like that social awkwardness at first where you kind of say, do I say hello to people? Do I still wear the mask? So it's fun. It is a little bit like the first day back at school after a long holiday. Coming up, Ed Clissold, Ned Davis Research Group Chief U.S. Strategist.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lines in New York. Now, Matt, I know we've been looking at importing, exporting Ducatis here and there, but actually there is some pretty good news in terms of virus in Germany, that they've actually, I guess, de-escalated the risk factor.
Yeah, the risk previously was super high, and now it's just high. So things are getting better here. No, to be a little bit more transparent, we have, I think, 35 infections per 100,000 people over the last 7 days. And we had reached a high of, well over 150. So things have improved drastically. And maybe that's just part of what happens in the summer. People are outside more, less together. As we've established before, I'm not a virologist, but it seems like in those kind of environments and economies, the virus is less of a problem.
Yeah, I think when you're outside, it's safe to say, although I'm not a virologist as well, but it seems to be the kind of, the message from the WHO. Kaylee, I mean, this also has an impact on the markets because, of course, we saw, for example, pound briefly touching a 3-month high on the back of, vaccinations in the UK really going to plan.
Yeah, and while the risks in Germany around the virus may not be super high, European equities are super high. In fact, they are actually at an all-time high today, the first trading day of June, with the stock 600 up 1%. And here in the U.S., futures are pointing to a higher open in about 4 hours' time, with S&P E-minis up about 18 points. Some selling in the Treasury market were up about 2 basis points on the 10-year yield to 1.61%. And then, of course, we are awaiting that OPEC Plus supply decision, that meeting happening today. And ahead of it, Brent crude is actually climbing towards $71 a barrel right now at $70.74. With those gains in oil, it does look like energy could be an outperformer on a sector basis in today's session here in the U.S. The Energy Select Sector SPDR ETF is higher by about 1.6% in pre-market trading, and some other stocks moving to the upside as well, one being TripAdvisor, higher by about 3.5%. The company's CEO was actually on Face the Nation's CBS's political show on Sunday, talking about that domestic travel recovery, and that seems to be aiding sentiment. Stellantis is also higher by 3.5%. They are resuming production this week at some of their plants in Michigan. And then, of course, have to check back on Cloudera, reportedly being looked at taken private at a $4.7 billion valuation by KKR and CD&R. That stock is higher by 19% in early hours, Matt.
I'm glad Stellantis is resuming production because you have to wait. I think the waiting list to get a Ram TRX truck is over a year now. So they can't make them fast enough. The margins are so fat on those. I'm looking at, one of the reasons that they had to stop production was the chip shortage, but also commodities across the board have just been more and more expensive to purchase. But it looks like hedge fund managers are reducing their bullish bets on commodities. Now, if you look at, Kaylee, what you were showing, all the commodities that we're tracking are up today. Iron ore is ripping face. But hedge fund managers last week reduced their bullish bets on 20 of the 23 commodities tracked in the Bloomberg Commodity Index. So it looks like at least the smart money thinks we may be peaking. Joining us is right now to talk more about this, Ed Clishold, Ned Davis Research Chief U.S. Strategist. Ed, the main question when it comes to these commodities, when it comes to those Ram TRX pickup trucks, when it comes to gas and chips is, are these price spikes that we're seeing just transitory, or are these higher prices here to stay?
Yeah, ultimately, they will be transitory. A lot of it does have to do with supply stocks and pent-up demand. But if you even look over the last 40 years, when we've been in this disinflationary environment, when inflation has ticked higher than the trend, stocks have struggled. So if you look at just the CPI, which is an imperfect measure, but it has a good history. If you look at it versus its 5-year average, when we get over 1% above the 5-year average, stocks have struggled, and we're well above 1% above the 5-year average, about 2% above the 5-year average. So even if it is transitory, it could still be a hiccup for stocks.
So how do you invest post-COVID? Do you look at small caps or value stocks?
Yeah, so the value trade, I think, still has longer to go. It's obviously been going on for a while, but there's two aspects to value. You have the cyclical value, financials, industrials, materials, energy, and those have been working, and we still like those areas. But then you have the defensive value, utilities, staples, and those areas have been struggling because they're low beta. So in the first year of a bull market, when stocks are ripping, you don't want to be in low beta. But those types of sectors may actually do a little bit better moving forward as the pace of gains slows. So there's a whole other aspect of value that could be coming into favor in the next few months. And we still do like small caps. We'll probably look to exit that trade because once you get deep into the second year of an economic expansion, small caps tend to start to underperform. So it's a trade we have liked, continue to like, but probably won't have for too much longer.
And how much of the good news is already priced in, though?
Yeah, I think if you look at sentiment, probably a lot of it. I think from here, it depends on how much earnings continue to be revised upward. We've had the biggest upward revision on record for S&P 500 earnings. But if you look at lots of sentiment composites, surveys of individual institutional investors, even just asset allocation, we're basically at record high stock percentages, plus you throw in the meme stocks, what they've been doing lately. It's pretty clear. A lot of people who want to be in the market are in the market. So the sentiment move is probably behind us. And now we got to do the old-fashioned thing and look at earnings and see if that can drive the market higher from here.
But is that going to drive the market higher? I'm looking at S&P 500 futures around 42.20 this morning, and the average strategist year-end target, so end of December, is 41.99.
Yeah, well, as one of those people who have the year-end targets, so it's something that probably a lot of people haven't revised yet. But I think the second half of the year probably will be tougher because as we move into the second year of a bull market, gains tend to be less. But also, too, by the time the really good earnings numbers are printed, then you have to look forward again. And so actually, the S&P 500 has done worse when earnings growth has been above 20% than when it's been, say, even -5%, -10%, because by the time you get plus 20% earnings growth, the good news is already priced in. Everybody knows it. So, and also it's not sustainable. So what we need to see is continued upward revision to earnings. Otherwise, the market's going to look forward and say, okay, that was the best of it, and gains will be weaker from here.
That's on the stock side. What about on the bond side, Ed? We've been in this range of between 160, 170 on the 10-year for some time. What breaks us out?
I find it fascinating that over the last decade, we had three tantrums in the bond market where the 10-year rose by over 100 basis points over a pretty short period of time. And it always happened before the event, before the taper, before the actual rate hike. And we had that happen again a few months ago. So now we got to see the next catalyst. I think it's when the Fed gets serious about a taper, then we can get a breakout higher on the 10-year, and maybe it'd be close to 2%. That's what our fair value model suggests where the 10-year could go. But that's probably not an immediate concern.
Ed, we've got a great big take on the Bloomberg terminal today saying, maybe this COVID trauma has changed economics forever. We're now borrowing and spending as quickly as we can and trying to get the money straight to people. Helicopter money is a term we used to use. The debt amassed by this, does that concern you at all?
Eventually, we're going to have to pay for it. Is it going to be something that's going to happen right now? Probably not. But if you want to think out over several years, the long-term bull market or secular bull market that started in 2009, that was driven by the Fed and printing money. It's probably going to die by the Fed and it's printing money no longer working. But for now, because of where we are in the economic cycle and where other inflationary pressures, demographics and the like are probably going to prevent the inflation from being more than just transitory, we'll probably be okay. But to think that we're never going to have to pay this bill is probably wishful thinking.
Ed, thanks so much. Ed Quissel there, Ned Davis Research Chief U.S. Strategist. Now, coming up next on oil and the OPEC decision, well, the IEA Executive Director, Fatih Birol, joins us. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
For generations, there's been certain ways to manage economic crises, and COVID-19 changed all that. Last year, the doctrine of austerity fell to the wayside around the world, and in the new economic approach, fiscal expansion took over from monetary policy. Governments channeled cash directly to households and businesses, running up record budget deficits, and central banks largely played a secondary and supportive role. Even in historically fiscally conservative Germany, policymakers scrapped a rule requiring balanced budgets. The IMF said that the biggest risk to the recovery was that governments would curtail their spending too soon. And in the US, the sentiment shifted away from that of the financial crisis. Clearly, no Americans lost their jobs through any fault of their own, and that helped clear the way for a big fiscal response.
With interest rates at historic lows, the smartest thing we can do is act big. In the long run, I believe the benefits will far outweigh the costs.
President Biden's team has fully embraced a new economic approach. It leans on proposals for higher taxes on the rich, more spending to benefit the poor, and policies that have been largely out of favor since the 1970s. While the response has pulled the economy out of its deepest slump on record, we have yet to grapple with theoretical problems posed by surging growth. And obviously, inflation concerns are fueling a heated debate. Some economists are more worried than others.
The highest inflation numbers are just ahead of us. I do think, though, that ultimately it's going to be more temporary.
I was on the worried side about inflation, and it's all moved much faster, much sooner than I had predicted, and I think that has to make us nervous going forward.
Other economists also say that we already had a generation of macroeconomic policy that was dominated by fears of doing too much. And now the economic attitudes seem to have broken out of that mindset. Lessons have been learned about how to get out of a downturn, and now we have to talk about managing and sustaining the boom.
Well, that was Bloomberg's Joe Weisenthal taking a closer look at how the pandemic has made fundamental changes to the global economic mindset. I'm also looking at what we're seeing with oil. I have to say the OPEC Plus Alliance meeting today is probably one of the most interesting in recent memory. Matt, the oil glut definitely built up during the pandemic is now slowly dwindling away, and we also see stockpiles, sliding pretty rapidly.
Yeah, and for sure, Joe's piece there, Matthew Bosler's take on, in our big take story today, plays into that. If the U.S. government is sending trillions of dollars into the pockets of American citizens, they're going to use a huge chunk of that at the gas pumps. They're going to drive as many places as they can, and they're going to fly when that's possible as well. So even before you think about the infrastructure investments, this is adding to oil use and the oil price.
Yeah, it certainly is. Now coming up. Coming up next on oil and the OPEC decision, the IEA Executive Director, Fatih Birol. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, Tom Keene, co-anchor of Bloomberg Surveillance, joins us. And Tom, I know you're looking at oil prices. Now, what is interesting for me is, of course, we have the OPEC Plus Alliance meeting later, and it's very clear that the robust recovery that we're seeing in the U.S., but also in Europe, means that actually they're confident enough to say that they can absorb some of the additional barrels that we saw during the pandemic.
Well, on June 1, there's an acceleration. $71 Brent gets you to where everybody said the year would start, and then up from here. There's different opinions on that. I know you've got Mr. B-roll coming up. Let's look at the chart. This is one of my most famous charts. It's just simply inflation-adjusted oil back 70 years. This is the calm before the storm of OPEC. Up we go, 2 rounds of OPEC, Persian Gulf, dead center in the middle. And then the great oil boom, well above $100 a barrel in 2021 dollars. We've come down, and of course, Francine, a new spike up.
Yeah, let's talk about the spike up. Tom, thank you, anchor there of Bloomberg Surveillance. Let's get to the man who knows everything about oil. The world has a choice: stop developing new oil, gas, and coal fields today, or face a dangerous rise in global temperatures. That's the bold assessment from the International Energy Agency. Well, joining us to discuss the new roadmap for the global energy sector is the IEA Executive Director Fatih Birol. Fatih, we'll look at prices in a second, but just as we transition to this net zero economy in 2050, do we need to see more about the societal impact that job losses as refineries need to adapt will entail? And good morning.
Good morning. Thank you very much. What we have done at the IEA is just a simple job of translation. Many governments, EU, United States, Canada, China, Japan, UK, many governments around the world committed themselves to bring the emissions to net zero by 2050. And these are not small words, these are commitments by the heads of states of those governments. And we just translated what that target means, to reaching those targets means for the global energy sector, what needs to happen in the energy sector so that the world can reach those targets to avoid the climate crisis. So we came up with several, more than 400 milestones. What needs to happen in the energy sector and when this needs to happen. Just let me give you a couple of examples. In the year 2035, the latest, we have to see 60% of all car sales to be electric cars, 5% from today. Or in the year 2040, 50% of all aviation fuels should be sustainable, non-oil ones. And as a result of these measures, we look at it, there is no need for new investment in oil, if it is the case there.
I mean, if you look at the price of renewables right now, how much do they need to fall by to make sure that some of the governments that have put these pledges will follow through with them?
Now, renewables are coming very strongly, very strongly. I mean, last year, more than 90% of all new power plants were renewables, more than 90%. It is going to grow. But renewables alone are not enough. We need other technologies as well, such as the hydrogen, such as the carbon capture, in some cases nuclear power, advanced battery technologies. There will be a major push for clean energy technologies, and it is the reason I know that you and most of the colleagues following your program are interested in the oil markets. Oil markets and the colleagues who are working on the oil markets should be ready for the next bumpy years to come, because there will be a big change in the global energy markets coming. I don't say that we will not need oil from today to tomorrow, but big changes are on their ways.
Sure, by 2050, things are going to be different. I probably won't be around anymore, but in terms of the next 6 months, Fatih, we're going to need more oil, right? I mean, even OPEC knows that supplies are going to dwindle. Do you expect them to release more production in the second half of the year? And if so, how much?
Yeah, so I will come to it in a moment, but the changes in the oil markets will not be by 2050. It will be much earlier, so therefore it is better to get ready by now. But looking at the next 6 months, I see that very clearly that there is a strong recovery of oil demand. United States, China, Europe, and elsewhere. And if the oil producers, OPEC Plus, stick to their current policies, we may see a widening gap between supply and demand. Of course, here is a wild card, which is Iran. What will happen with Iran? Iran is today producing about 2.4 million barrels per day, the record in the last 2 years, but still more than 1.5 million barrels per day. There is an unused capacity there, which can come to markets in case there is an agreement between Iran and the international community.
How much do you think they're going to have to ramp up supply? How much do you think OPEC is going to have to open up the taps in a barrels per day kind of way?
It is up to them to decide how much and if at all they are going to do it. But one thing is clear: in the absence of not changing the policies, with the strong growth coming from United States, China, Europe, we will see a widening gap, which in turn would put further upward pressure on the prices. We expected a demand in 1 year or so may well come back to the levels of before crisis. Of course, there are many uncertainties we see from India related to the COVID, but broadly we expect that in 1 year or a bit later, if the aviation sector comes back slowly but surely to the previous levels, we may see in 1 year or so coming back to the 2019 levels of oil demand.
Fatih, you mentioned India, obviously a major importer of oil. You also have issues in places like South America, and then international travel still largely is pretty much on hold. So in the near term, is it risky for OPEC to be increasing supply?
I mean, risky for whom? Producers or consumers, of course. But our numbers show that in the absence of a policy change, increasing the production or other policy changes coming from OPEC countries, with the demand recovering, the current prices, which are already very strong in the last few weeks, may further see upward pressure.
Thank you so much, as always, for giving us a little bit of your time, the IEA Executive Director there, Fatih Birol. Now, coming up in the next hour, John Stoltzfus. He is Oppenheimer Asset Management Chief Investment Strategist. We look at the markets. We look, of course, at OPEC+, that alliance meeting at a special meeting a little bit later today that will probably decide what oil does next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Our generation's biggest problem.
Climate change is happening.
and the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Everything is in place for inflation to rise, and I think it's going to rise significantly enough to make the Fed uncomfortable.
If people expect inflation, then they're more willing to accept it.
The risk-free rate right now is manipulated by central bankers all over the world.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
We step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Kicking off the month of June from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures up 17 on the S&P. We advanced 0.4%. What a month we've got coming up for you. The ECB coming up in about a week. The Fed after that. Before we get there, Tom Keene, Friday, payrolls.
Yeah, well, Friday payrolls will be very, very big, John, but I really center on the Fed meeting June 16th and the basic idea this morning that the markets are doing what the Fed wants. They're doing the heavy lifting for the Fed. George Saravelos with a very sharp note from Deutsche Bank in the last few hours, really talking, John, about it's just like a rate cut to see the dollar dynamics in the short rate market with the flood of money, the wall of money the Fed has given us.
And we've got some stability in the bond market too, Tom, we need to talk about. Right now, a 10-year 162. Your average since 10-year yields topped out at the end of March, 161, 162. I'd argue that's probably good news for them, isn't it, over the last couple of months?
Yeah, the stability there is great, but in the short, where the pros are in the short rate market, there's a lot to watch for. Overnight reserves, I don't know if I have a good reading on that yet, John. It hasn't really ballooned out to new highs over the long Memorial Day weekend, but it's just the wall of cash that's out there as we end the pandemic in America is really moving markets.
Are you calling the end of the pandemic, Tom? Are we done?
I'm not. No, let me be careful there.
In the United
States,
just to clear that up.
In the United States, I'm calling it, but I'll tell you, it's shocking in other nations that are behind on vaccination.
Lisa, 650,000. That is your estimate this Friday.
And transitory is really the key word, as Tom was talking about. And I'm wondering how much we're going to get any nuance to what could be transitory from Federal Reserve officials before their blackout period, given the fact that there is this wall of cash that's going to continue pushing asset prices higher, regardless of the fundamentals, whatever that means anymore, John.
Jim Bullard in the FT. Tom Keene, Jim Bullard sounding very, very hawkish at the St. Louis Fed. Lisa bringing up the Fed speakers. I think you've got to look out for that. He's not alone. That list of people is starting to build quite quickly.
Well, it sets up for a June that's going to be interesting. I mean, with the commodities busting out all over is one thing Mr. Bullard's looking at. But you're right, and there's going to be different nuances here. And, you know, I'm not a big fan of the parlor game of the Fed speak, but the idea here, John, of look at the markets as they try to price a global recovery from this natural disaster.
Well, let's look at the markets right now, Tom. Tuesday morning, good morning. Equity futures up 18 points on the S&P 500, 4220 through 4200 on the S&P. We advanced another 0.4%. How many times have you said that, TK?
I said it to a huge
repeat. Going to hear it again and again and again. In the FX market, euro dollar unchanged, 122.28. Lisa, yields just sat the 162 on a 10-year this morning, just creeping higher by a couple of basis points.
Yes, the name of the game, though, as you said earlier, is stability. We continue to see that stability in bond markets, and I really am trying to understand what the marginal deciders could be for the Federal Reserve as to when to start talking about tapering and really talking talking about transitory, which may be a bigger deal. All right, here's what I'm looking at today. Starting at 9:45 a.m., we get a slew of manufacturing data. 10 a.m., we get U.S. April construction spending and May ISM manufacturing data, followed a half an hour later by the Dallas Fed Manufacturing Index. Key question in my mind, how much have input costs increased? In other words, the inflationary impulse into the producer, how much has that forced them to consider pricing and force prices higher for the end consumer? We have seen this again and again. How much does this crimp what they actually produce? These are questions that people are looking at to try to determine, decipher how long-lasting, how transitory this inflation really could be. 2 p.m., Lael Brainerd of the Federal Reserve, Fed Governor, going to be speaking at the New York Economic Club. Again, the key question I have is, what are they looking at to determine when they should move away from this temporary blip? What are they going to potentially reconsider? And she could follow in the footsteps of Jim Bullard with respect to taking a little bit more of a hawkish tone. And then today, and this really is probably the key market story of the day, OPEC Plus is meeting to discuss July output, expecting to ratify output increases. We see prices on Brent, prices on WTI rising to the highest levels in about 2 years because people are actually driving places and actually flying places, John. And this has led to something of more of a tightening in supply-demand dynamics. The key question really is Iran and what happens if the agreement comes to a pass and they're able to start shipping oil.
Elisa, that's the commodity market. Your take on foreign exchange. Dollar China 638. Your take on the latest move out of China.
This is a huge, huge deal. And basically, China, for a long time, allowed the yuan to strengthen versus the dollar. And then yesterday took a pretty big measure, starting to actually came out with a peg that was weaker than the expected reference mark for the yuan. And then today, for the first time since the financial crisis, required banks to hold higher reserves of foreign currencies, basically trying to weaken, to offset some of the rise in the yuan. I really wonder how far they will go, what triggered this, and what this means for a dynamic that a lot of people thought they would actually allow to continue to climb.
It's a 10% move in China's favor over the last 12 months. Tom, here's your headline. Nobody wants a stronger currency. This one's going to get a little bit more interesting if we have to see some dollar weakness in the months ahead.
The old line race to the bottom. I would note moments ago, euro-yen, which is a major pro pair, just went out to strong euro, weaker yen. And one of the overlays here, as we go to John, one of the overlays, John Farrow, is the stronger euro. It's irrefutable.
Well, let's go to John right now. John Stolfus, Oppenheimer Asset Management Chief Investment Strategist. John, let's start right here. Just a massive month ahead of us. The ECB, the Federal Reserve, payrolls this Friday. After the big downside surprise on payrolls last month, what are the lessons learned going into this Friday?
Well, I got to think that investors are going to have somewhat a trepidation as we get closer to that Friday date for the non-farm payroll number. I mean, they're looking for what, 650,000 K versus 266K, which is what we got the last time. And ahead of that, as I recall, there were some predictions that it was going to come in at 2 million. So we'll just have to see how it goes. Our understanding of the markets from the period that we've been in the markets, the last 38 years, is this is not uncharacteristic, the uncertainties that we're dealing with when you're coming out of a major crisis. And you just have to right-size your expectations.
John Stolfus, I want to congratulate you on being a persistent and courageous bull in the heat of the pandemic. You were right. What is the thing you're studying or the thing that would trigger you to a more cautious outlook?
Tom, it would really be an indication that the Federal Reserve was indeed asleep at the wheel, that it had become locked into this idea of just leaving the faucets running irregardless of inflation ticking up, should it become no longer a transitioning or transitory kind of occurrence. That's what would worry us. We look at the economic data on a daily basis, and so far it's so good. It's not great, but it's not poor. Progress being made, and the inflation that is occurring is still linked to some of the disruptions in the supply chain in a wide variety of areas, from food to technology.
Well, that's the economy, and the economy and the stock market are not necessarily on the same trajectory. There are signs of cooling in certain pockets of the froth, whether it's the SPAC market, whether it's the IPO market, where you're not seeing the same kind of pop as you used to, whether it's the junk bond market, a feeling that things are actually hitting their peak. Do you think that this is a blip, a pause in an incredible rally, or do you see this as a sign of what's to come for the rest of the year?
Lisa, our particular focus is really on the core of equities. So, what we're looking at is a combination of growthier value and garpier growth. Stocks that are doing quite well, actually, in this period. We think when it comes to the SPACs, when it comes to the IPOs, that's where you saw the froth. And they are essentially they're not the center of the circus, so to speak. They are other rings on the outside, or what you might call the side rooms in Las Vegas. The lounge acts.
Too many fancy terms, John. Way too many fancy terms. Can we keep this simple? Are we sticking with the banks, the big banks on Wall Street?
Yep, we want to stick with the banks. We want to stick with the industrials, and our contrarian picks for the third and fourth quarter. We think you want to be now accumulating big tech, and you also want to be accumulating consumer discretionary, which is likely to benefit from a successful reopening of the U.S. economy.
John Stolfus, we've got to leave it there. Fantastic work, as always, sir. Oppenheimer Asset Management Chief Investment Strategist on the equity market and the path forward after delivering another tidy month of gains for the month of May for the S&P 500 banks. Here's the quote from Jim Bullard, the St. Louis Fed president, speaking to the Financial Times in an interview this morning, guys. I'm evolving towards a judgment where labor markets should be interpreted as fairly tight. He goes on to say, quote, even though it's a booming economy and GDP is growing leaps and bounds, I'm not sure employment is going to follow. Tom, you sent me that interview this morning. What's your take on that?
My take is there's three Americas out there, and Dr. Bullard is exceptionally prescient on this. His work out of Indiana over the years and the research heritage of St. Louis. There's a fully employed America, John, across all the different deciles. There's another part of America coming back from the pandemic, so it'll be like February last before the pandemic. And then there's a part of America that's undertrained. Jeff Sachs has been brilliant on this at Columbia. There's a whole piece of America that just is not in the game. Dr. Bullard's adjusting our labor dynamics for that group that's not in the game.
Lisa, President Bullard adding that he did not expect monthly job gains as high as 1 million in the coming period.
I wonder what the pressure is, though, on him that's causing him to take a different tack. Is it worries about financial stability? And this, to me, is a key question, as Tom was talking about all that cash sloshing around. It's got to go somewhere. So if we don't see the inflation in the core economy, if we don't see more employment, you get asset price inflation, and that's got to be scary to certain federal officials, Federal Reserve officials.
Yeah.
And you wonder how much that's what's underpinning some of his concerns.
I'll avoid taking a guess on what he's thinking, and I'll just take a look at what he's actually saying. He's worried about persistently above target inflation, I think, Lisa, going into next year. Pretty much what he says in this interview. And if the labour market is tighter than they all think, then that really, really raises the prospect of being behind the curve in the years to come.
But it also means that he doesn't have faith that the Fed has the tools to address that inflation in a calm way with respect to the markets in that circumstance, which is actually counter to what a lot of people, including Janet Yellen, have been saying.
How lonely do you think he is on the FOMC right now? Pretty lonely?
I think less lonely than he was 6 months ago.
John, we slotted in the pendulum of stability here at 6:12.
I think that sounded a little bit more doomy than stability, to be honest with you.
Come on.
Don't you think?
Research.
He's had a long weekend, Tom.
To really just pump up the gloom.
Took the extra day off.
All I was told, I got to watch
this.
Kate Winslet. I have been told by 42 family members, stop everything and watch Kate Winslet on HBO, and I'm trying to get there.
Yeah.
She goes, Jack,
Mayor
Jack.
of Easton.
I think that's a different movie. Tom. 7 a.m. Eastern time. Ed Yardeni Research President. He's thinking of Titanic. You know that moment, Lisa?
But that's not what's on HBO.
I know. Tom's just distracted. I have no doubt Tom's going to watch Kate Winslet whilst this program is on.
That was in
From New York. This is Bloomberg.
With the First Word News, I'm Riska Gupta. China has taken its most substantial move yet to rein in the surging yuan. Beijing is forcing banks to hold more foreign currencies in reserve for the first time in more than a decade. That effectively reduces the supply of dollars and other currencies on shore, and that puts pressure on the yuan to weaken. President Biden will unveil plans aimed at reducing the black-white wealth gap. That will happen today in Tulsa, where the president will mark the 100th anniversary of a massacre that took place in a prosperous black neighborhood. President Biden is expected to offer proposals aimed at boosting home ownership and helping minority small businesses. In tennis, women's star Naomi Osaka has dropped out of the French Open because of a dispute over mandatory press conferences. Osaka said in a social media post that she has suffered from depression and social anxiety disorder. She says that taking part in press conferences makes matters worse. Osaka is ranked second in the world. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
president keeps saying inaction is not an option, and time is not unlimited here. The American people expect us to do something. They expect us to deliver, and it's my hope that these continued conversations, really over these next few days, will be productive and will lead to that clear direction.
Secretary Buttigieg there doing the rounds at a Sunday talk show stateside over the weekend from New York City this morning. Good morning. Alongside Tom Keene, Lisa Brabitz, I'm Jonathan Ferro. Tuesday morning, price action set up as follows. Equity futures up 19, advancing 4.5% in a bond market. Yields just south of 162 at 161.98 on a session up by a couple of basis points. And kicking off the month of June in the FX market, euro dollar in and around 122, 122.28, and totally unchanged on a session. Brief mention of crude, a tighter commodity market, a tighter oil market later this year. OPEC Plus looking for some of that, $68.12 on WTI, up by about 2.7% on the session, Tom. Crude advancing this morning.
Yeah, really nuanced today. For June 1, as we start the summer, there's a lot going on in the markets. Again, John Stolfus there on the equity lift and his optimism as well. Right now, to stagger through the weekend and to survive into a 4-day work week in all of June, Martin Schenker joins us, Bloomberg editor-in-large in charge of voting rights here at Bloomberg. It is sort of an arcane topic, but there it is. And over the weekend, the Texas Democrats waltzed out of the legislature. The Republicans were stymied. I guess they'll get something through. It's a battle brewing to 2022. How does Washington affect states' decisions on voting rights?
Well, obviously, the issue of who is eligible to vote is a states' rights issue. If Washington wants to inject itself into the debate, it's going to be rancorous, to say the least, if the Washington establishment tries to enforce voting rights on the states.
Does Greg Storr just understand this will end up in the courts?
It will probably end up in the courts, indeed.
Yeah.
And then it'll just be a basic states' rights issue. Who decides who gets